On this Friday, October 25th, welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Madison Mills, and let's get you the three things you need to know today.
First up, U.S. stocks looking to snap that 6-week winning streak as investor sentiment switched into risk-off mode. The U.S. stock futures carrying Thursday's momentum into today's session as investors gear up for a big week, including more Mag 7 earnings. We've also got the October payrolls report.
Tesla shares lower today after soaring 22% following its third quarter results. The EV maker's market cap rose to $836 billion. That added about $34 billion to Elon Musk's net worth. The rally was Tesla's biggest in more than a decade and further cements Musk as the world's richest person.
And Apple getting a downgrade on Wall Street ahead of its earnings results next week. Analysts at KeyBank downgrading the stock to a sell equivalent, saying expectations for a broad rebound across its businesses are unrealistic. Meanwhile, new data from the IDC showing Apple returned to a top 5 spot in China, helped by the launch of the iPhone 16.
U.S. futures are in positive territory this morning after Tesla's massive rally boosted tech stocks, but the S&P for the week on track to snap its 6-week winning streak. We have seen a bit of a pullback here, but I think what's important to note, Maddie, is when you take a look at the levels for the S&P here on Friday as we close out the trading week, we're still not too far from those record high levels. And I think, yes, we have had a bit of a pullback, but as we look ahead to next week and how critical that will likely be for the market. When we start to hear from more of the Mag 7 companies, of course, much of the earnings growth, they are still expected to be a driver or the driver of earnings growth this quarter. So I think that's really going to be key just in terms of determining maybe the leadership from here on out, but also just setting the momentum or the pace that we could see through the end of the year.
And it's important to note that Tesla is the reason that we are seeing these moves to the upside this week off of such a kind of iffy week for markets. It's going to be interesting to talk to our guests throughout the show about how something just feels a little bit off. Bank of America's Michael Hartnett saying that investors are betting on gold heading into the election, so a little bit of a risk-off mentality. But Tesla kind of delivering that early Christmas gift to the market, adding a market cap the size of a couple of automakers in Europe combined in just one day, and then pushing, of course, the S&P into the green as we head into the end of this week.
Yeah, and of course, we should also call out the action that we've seen in the bond market, too, this week, because that really has been a driving factor. When you take a look at the sell-off that we've seen in bonds, is moved to the upside that we've seen in the 10-year Treasury, right around ththose 4.2 levels. We've been talking to a number of strategists right now this morning, just below that level, but we've been talking to a number of strategists just at what level or at what rate does this become potentially problematic for equities, and seems like consensus is not until we are right around that 4.5 level do we start thinking about that. Well, there are just 10 days until the presidential election. Our next guest saying to expect volatility no matter who wins. Joining us now, we want to bring in Lou Bazanis. He's MDB Capital President and Chief Market Strategist. Lou, it's great to have you. So what's been interesting in the market action really over the last couple of weeks is this pricing in that we've been seeing of the Trump trade, and a lot of that off the back of some of these betting markets. I'm curious how much of that has been fully priced in at this point.
I think a significant portion has. I mean, if you look at the correlation between the betting markets and the stock market since March, it's been a stronger correlation than the stock market and treasuries. So everyone's always talking about yields are up, stocks are down, and vice versa. I think a lot of cash is priced into and speculating wildly. There's a very big difference between a Trump win and a Harris win, from corporate tax policy, individual tax policy, energy. So I think there's going to be some adjustments if there's a definitive winner come November 5th. So if there's not, I think that's what everyone's scared about. You talked about people buying gold, Bitcoin. I think those are just catastrophe hedges because if we have an undecisive election, no one knows what's going to happen, right?
Is there that big of a difference from a market's perspective, though? They're both going to increase the deficit. That's obviously going to do the same thing to yields.
Yeah, so we can kick that can down the road endlessly. It seems to be the status quo in Washington, D.C. I think the big differences are sector specific, right? We talk about EVs, right? Before Elon came out in support of Trump, I think you should be really scared about the EV market on a Trump win because he's going to cut back subsidies, really move away from a renewable mandate. I think you also have to look in big banking, right? Are we going to get Basel III and adherence to that under Harris, or are we going to move away from it and more leniency under Trump? So on a sector-by-sector basis, I think you have to be particularly cautious. One that I would say is immune to it is maybe biotech, because we need life-saving drugs no matter who wins the White House. So that's how we're looking at things now, is just be very specific, but value conscious, right? So if you look at large caps, they've really run up. I think the areas of the market that get interesting are small caps that are profitable, that biotech space that's really rebounded off the lows going back about 4 or 5 months.
Well, what about the move higher that we've seen in the dollar? Because that certainly has been on a tear. A lot of that having to do with the Trump trade and the odds here, maybe of what the betting markets see as him winning. Are we near peak levels, or if we do see a Trump victory, is that going to continue to push
it's funny, right? I would say the currency markets, you typically have to have a PhD to understand the every gyration there. I think you can very simply boil this down to it's a relative world, right? So relatively speaking, the U.S. economy is doing much better. Relatively speaking, we're not cutting rates as fast as everyone else, and money goes where it's treated best. So I think that's part of a component of it, and then there's a Trump component of it too. I think you could argue the other side though, right? Trump could be very bad for the dollar because of his just isolationism. So I think you have to really just take in the basic economics.
Is the market almost reading that wrong?
Reading what wrong? That Trump is good for the dollar?
Yeah.
Yeah, I think so. I mean, look,
you
would classic economic analysis, right, would say that tariffs are not good for your currency, and America first, or just your country first policy is probably not going to be good universally. So I think, again, it's never a single variable. You got to factor in interest rates are always going to come in, right? So people were chasing yield with a yen carry trade, right? So they could borrow very cheaply and invest it elsewhere. If the Treasury market's paying really attractive yields relative to the rest of the world, the dollar is going to remain strong.
But it's also, to your point, do we know how much of this is the so-called Trump trade? You said in your notes, ever since March, the stock market's been trading higher in anticipation of a Trump win. You don't think that's the Fed cutting rates after the most aggressive hiking cycle in
right.
decades?
It's never one thing. So I would say this, like the Treasury market, what we've seen in the last couple of weeks, this rise in yields, like going back and where's the dangerous level, is the market adjusting to the fact that the Fed's not cutting as fast as we thought, right? We got 50 basis points. Everyone rushed to buy bonds because they thought that it was a race to lower rates, much lower rates. And then we see a stable jobs market, inflation a little bit stickier, and everyone, now the Fed rate cuts are going to be much more measured based upon the futures market. I mean, we saw that massive swing on that jobs report where it was everyone's expecting a 50 basis point cut, like 30% odds, and it went down to 5% immediately after that jobs report. So it's just it's a recalibration. Everyone knows rates are going lower. We just don't know at what pace.
And what's been interesting, and I was going through some of the commentary that we've been getting out over the last couple of weeks since the start of earnings season, and it seems like European countries have been talking a lot more about tariffs and the implications of that than the U.S. companies so far. When you talk about what a tariff regime could potentially look like under Trump, is that almost a worst-case scenario then for some of these European equities?
Yeah, I think they've prepared for the worst, right? You have to anticipate it and then expect the best, right? You have to move towards policy. So if they embrace it now, I mean, if we look at it from the U.S. perspective, what do most companies do when they fear a recession? They start talking about it in advance, preparing investors. I think European equities, corporations are doing that. Hey, look, this could be really bad for us. It could make things much more challenging. And then, you get the bad news out all at once, you trickle out the good news. So I think they're trying to flush the bad news down the drain here. Like, this is really what could be a negative drag, and then start saying, oh, hey, it's not as bad as we thought. Things are improving. The tariff regime isn't as strict. Or guess what? Trump didn't win. There is no tariff regime. So.
Well, it's interesting, too, when you compare European equities to the U.S. just because of the degree of difference in gains. I'm looking at the FTSE right now. Year to date, it's up 7%. Yep. If you've got the tech trade that is rallying in the United States, does any of this matter?
Maybe not, but I think if you focus on valuation, there's European stocks that are starting to get really attractive. Like Nestle pays a stable dividend, trading at a single-digit PE ratio. Like, you're going to start looking for value. You have to. I think if you look at the U.S. equity market and large caps trading 20-plus times earnings, the Mag 7 in the 30s, yes, they're growing earnings, so that as price stays the same, all things being equal, they're getting cheaper if they grow earnings. But again, I think at some point, the value bias kicks in and people are going to go, hey, I can't just trade momentum nonstop. I've got to allocate to things that are undervalued.
Lou, it might be hard to narrow this down, but between now and year end, what is your top trade, or what is the number one thing that you think investors should be keeping on their radar, just given so much?
Yeah, I think small caps, right? This has historically been just an underperformance, not even decade, but last year or so. You've seen some fits and spasms where they're going to catch up to large caps. I think there's just tremendous value there. We've seen it especially in biotech. So if you buy the Russell 2000, you're getting about 30% exposure to the biotech. You could invest in a biotech ETF. The XBI is more weighted towards the smaller ones. I think you get a lot of bang for your buck there because there was a lot of biotechs that came to market very early, only on preclinical data and phase 1. That were trading below cash. So, I mean, about a year ago, we had about 300 biotechs trading below cash. Not a huge bounce in those valuations right now, but you are seeing these drugs advance through the clinic. So companies that are showing promising clinical evidence going from phase 1 to phase 2, small cap biotech, I think is going to be an area that's really interesting. There's an IPO coming to market today. It's a biotech phase 1, raise the price, raising about $288 million. That's a really good sign and harbinger for biotech.
All right, Lou, thank you so much. Really appreciate you joining us in studio. Thank you. Coming up on the morning brief, we're going to count you down to the opening bell on Wall Street with stocks set to snap those 6 weeks of gains. Plus, the parent company of Versace plunging after a federal judge blocked its $8.5 billion merger with Coach parent Tapestry. The details of that ahead. Also, Apple getting a downgrade ahead of its earnings report next week. We'll break down why on Morning Brief next. It's now time for some of today's trending tickers. You can scan the QR code on your screen to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Apple back among the top 5 smartphone providers in China, boosted by the launch of the iPhone 16. The company failed to crack the top 5 last quarter, but regained market share in the third quarter, taking second place behind Vivo and coming in ahead of Huawei in third place. Apple also getting a downgrade over at KeyBank, cut to underweight with a $200 price target. Analysts citing iPhone sales concerns and unrealistic expectations for 2025 growth. There's a lot to talk about with Apple this week because we also have Tim Cook in China kind of kissing the rain. It worked for Elon Musk. Maybe it's going to work for Apple. He's taking selfies with influencers in China throughout the week. They're posting it on WeChat. Maybe that is a lift to these iPhone sales. But historically, this third-party data on iPhone sales, it can be a little bit iffy.
It can be a little bit iffy, and I think my takeaway is obviously, yes, clearly this is good news here for Apple just in terms of their placement back in the top 5, but you also see the rise of domestic players. And I think ultimately in terms of that longer term game plan, this is going to be a real risk. It is a real risk. It is a challenge there in terms of Apple's further, not so much dominance, but even just competitiveness within the space, what exactly that is going to look like going forward. We also have to talk about the rise of the geopolitical tensions between the two countries. That, of course, has been something that has talked about that has affected sales here most recently. So I think going forward, that being one of the unknowns is why we're seeing this street relatively split when it comes to Apple and what some of those, at least short-term gains are going to look like. We had a call out from KeyBank earlier today downgrading the stock to Apple, saying that some of the expectations in terms of growth across the board, they called it unrealistic. Their analyst, Brandon Nispel, went on to say that he's downgrading it on the view that assumptions that the company are going to record its highest growth in more than 3 years, along with a major inflection across its business, that is quote unquote aggressive. He also went on to say that he's becoming bearish for the first time since initiating coverage 3 years ago. And I think that really sums up what the next couple of quarters, the next couple of years could potentially look like for Apple, given that there is so much uncertainty when it comes to not only those geopolitical headlines, but also just how much it is resonating with the Chinese buyer specifically, given how important it is to Apple. But then, of course, like you said, Cook is over there meeting with Chinese officials, doing all he can, obviously, to try to maintain that stake in the very important market.
And you mentioned the mixed reaction from Wall Street. I just want to mention 65% of the street has a buy on Apple, still 30% having a hold. So we will see how that potentially changes in the weeks to come.
All right, let's take a look at the airline space. Spirit Airlines announcing plans to cut costs, trimming jobs, and agreeing to sell 23 Airbus planes worth more than $500 million. The budget airline has been struggling since its proposed merger with JetBlue was called off. That happened back in March. Earlier this month, the Journal reporting that Spirit was considering filing for Chapter 11 bankruptcy. You are looking at shares really getting a lift, to no surprise, on the heels of this news, up just about 26%. But I mean, the company's facing a liquidity crisis, right? And that has been clear because of the steps that have been taken by Spirit ever since their merger with JetBlue was blocked. There have been some interest from Frontier. That, of course, has been something that we've been talking about a lot this week. But I think just going forward, some of the other cost-cutting measures that were announced here from Spirit, identifying about $80 million of annualized reductions that it plans to begin carrying out early next year. So I think the jury's still out on what Spirit's going to look like even a couple of quarters from now. But again, at least this morning, you are seeing, I guess you could call it maybe some relief on the street as we're looking at the move higher in shares. Yeah.
But it's, I think, going to be really important to see what the FTC does here, because if we see a company like Spirit under so much financial stress that then the FTC is looking at it as a potential, well, if we don't allow this merger, maybe there's more cost cutting in the future. Maybe that's telling to businesses moving forward about whether or not a deal is going to get through. Does it get through only if you previously announced job cuts at your company and then the FTC takes that into account? Certainly something that we're going to continue to talk about as we move on to our next trending ticker here, because a deal between Tapestry and Capri Holdings blocked by a U.S. judge, citing reduced competition in the luxury handbag market. Yahoo Finance's Alexandra Canal joining us with more on what's next. So Tapestry is going to appeal the decision, but then it's interesting. We also had a note from Citi this morning saying that this maybe wouldn't be such a bad thing for Tapestry. What are you looking at?
Yeah, and it's interesting to look at the stock moves to that point. I mean, this is a merger that has been held up for well over a a year now at this point as the Federal Trade Commission really cracks down on what they deem anti-competitive practices. The FTC had moved to block the acquisition in April, seeking a preliminary injunction to stop the deal. That injunction was granted on Thursday. And like I mentioned, we're seeing the aftermath of this news hit shares hard. Capri Holdings down around 45% in pre-market trading, but like we were alluding to, Tapestry shares are moving higher, up around 13%. Now, in a court filing obtained by Yahoo Finance, the U.S. District Judge ruled that, quote, antitrust has come into fashion, arguing that a merger between the two will substantially lessen competition in the market for accessible luxury handbags. As a refresher, this combination would have brought together 6 very high-profile fashion brands under one roof. We have Tapestry's Coach, Stuart Weitzman, and Kate Spade, with Capri's Versace, Jimmy Choo, and Michael Kors. In a statement, Tapestry said the companies, quote, operate in an industry that is intensely competitive and dynamic, constantly expanding, and highly fragmented among both established players and new entrants. We face competitive pressures from both lower and higher price products and continue to believe this transaction is pro-competitive and pro-consumer. Now, in its arguments, Tapestry had also said a merger was necessary to compete against dominant European players like Gucci. Yahoo Finance did have the chance to speak with Pauline Brown prior to this ruling. Pauline is a former North American chair at LVMH, which owns fashion brands like Louis Vuitton and Dior. Here's what she had to say about this at the time.
I think the trickiest part of their legal argument is that there is a natural market, not for handbags, and not even for luxury handbags, but for what they're calling accessibly priced handbags, luxury handbags. And I mean, the reality is, I think it's a spectrum. I think the customers, if they're happy, they'll still come at the right price for the right designs. And if they're not, they're going to go to another player. So I think it's a feeble argument.
And that seems to really be what the feedback is here, guys, that if you are a luxury handbag consumer, you're going to pay for that no matter what the price is. If you want a Coach bag, that's what you are going to do. Now, regardless, this has been viewed as a win for the Biden administration, which has really been trying to crack down on anti-competitive practices. You think of the potential breakup of Ticketmaster, Live Nation. That was a biggie earlier this year. But the general consensus seems to be, why is the FTC focused on this when there are so many other issues that the average American needs fixed rather than luxury handbags? So it'll be interesting to see how this develops.
Yeah, and I thought it was also interesting that they described it as almost the middle ground between the cheaper handbags and also the very much higher end ones. And then also just the reaction that we saw, going back to your comment there, just in terms of it being a victory for the Biden administration, what we saw for some of the other deals that are facing scrutiny right now, like Albertsons and Kroger, those shares moved off the heels of this ruling too. All right, Allie, thanks so much.
Thank you.
Keep right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. You're watching Morning Brief.
I run this place with my husband.
Talea is the only female-founded brewery in New York City.
We opened our first location 1 week before the pandemic.
The market changes quickly, the landscape changes quickly.
What we didn't have was money or investors.
So we turned to crowdfunding.
Every incremental sale that we make is a new door we're opening.
We were able to raise about $30,000.
You have to be able to persevere and take the leap.
The plan is to get to 100 locations.
We are here to expand the craft beer market.
It's time now for our chart of the day. Ahead of big tech results next week, we're going to take a look at how much energy some of those Mag 7 members need to run their data centers. Apollo's Torsten Slok out with this chart this morning, indicating that right now the largest hyperscale data centers run by the likes of Google, Amazon, Microsoft, those require about 1 gigawatt of power, and that's expected to soar to 18 gigawatts by 2030. So to put this into context, we're going to look at New York City's power demand. It's about 6 gigawatts. So to add the 18 gigawatts to the U.S. power grid, you need to build 3 times the power grid of New York City just to support data centers alone. That's not including all the other energy demands that you can see on the bottom part of this third bar here that are required and expected to increase as well, just as everyday life requires more energy. Now, this strain on the grid, it's not easy. It's also not cheap. Infrastructure upgrades are very expensive, take a lot of time. And this energy use, it also impacts the environment. That's part of why we've seen such a push to nuclear energy, as several hyperscalers are partnering with nuclear energy companies in an effort to get access to clean energy. And that is part of the growing demands overall of data centers, guys.
All right, Maddie, let's do a check of the futures here ahead of the opening bell. We're taking a look at, actually, that's the opens. Let's scroll down to futures here. You got Dow futures pointing to the upside here on set to open the day, up just about 0.4%. You're looking at the Nasdaq 100 futures also moving in that direction, as well as the S&P 500. If this does hold and we do in fact see gains at the open, then of course carrying through today's trading session would obviously pare back some of the losses that we saw earlier this week. Taking a look at the bond market, because that really is where we have seen so much of the important action here this week. We're seeing a bit of a pullback here in yields this morning. We saw that climb above 4.2, but again, we're still about 10 basis points higher than we were where we started the week. We're at 4.19 here, just ahead of the open. And taking a look at maybe what we have seen over the past several trading days, when you take a look at the move lower that we have seen in the Dow, still on track over the last 5 trading days, off just about 2%. When you take a look at the S&P 500, that's off about 0.5% over the last 5 trading days. Of course, when you take into account Tesla's results that were out after the bell earlier this week, helping to boost some of that sentiment that had been dragged lower here heading into earnings results. When you take a look at the Nasdaq, that actually over the last 5 days is still holding on to gains, up just about 0.2%. When you take a look at inside some of the major averages and some of the movement that we have seen, and not only on this is a sector basis here on an intraday level. When you take a look over the past 4 trading days since the start of the week, you're looking at consumer discretionary, the lone gainer here on a sector basis here so far this week. On the flip side, you got materials under a significant amount of pressure. That's entering the day off just about 3%. Industrials and healthcare not too far behind. Taking a look inside the Dow, a number of the earnings results that we have seen come out over the last several days, a number of those have been Dow components. When you take a look at Coca-Cola, that stock off just about 4.5% over the last 4 trading days. We know McDonald's hit with an E. coli outbreak. That has really weighed on shares. On an intraday basis, you're still looking at gains yesterday of just about 1%. But when you take a look at the 4-day chart, you can see the dip that we saw following that report of the E. coli outbreak. So for the week, you're still looking at losses of nearly 5%. And then I also want to draw attention to what we're seeing, some of the red on the screen when it comes to some of those bigger cap tech plays, larger cap tech plays. That, of course, is going to be in focus as we look ahead to earnings results that are coming out next week. It's going to give us a better idea of what CapEx spending looks like from some of these larger cap tech companies. And then, of course, what that tells us about the appetite for AI trades going into the final months of the year. Well, that's opening bell on Wall Street as we kick off the final trading day of the week, and flipping it back over to the major averages to see where things are shaping, or how things are shaping up for the day. Again, you're looking at gains across the board for the major averages. I've got the Dow up, opening up just about 154 points. You've got the S&P up about 0.5% here, climbing further above that 5,800 level. And then, of course, as the Nasdaq calibrates here, we could be looking at gains also at the open as we do wait for that to open. Now that it is starting to trade here up just about 0.5%. So we'll see whether or not this move to the upside holds in today's trading day. Let's kick it over to Jared Blickery. Jared?
Thank you, Shauna. Yeah, it'd be nice to end the week on an up note. And let's take a look at what the Dow has done, because the previous 4 days this week, it has been down. And here's a 5-day total. You can still see that it's down about 1.75%. So we'll see how much it can claw back from some of those losses in the prior days. The Nasdaq was flying yesterday. That was really a Tesla story. You can thank the earnings in Tesla propelling that stock about 21%, and that's a consumer discretionary story as well. But I was looking at the longer term in the Nasdaq. This is a 3-year chart, and in fact, let me just show you the 5-year chart here. We did a nice breakout a couple years ago, and now we are doing a very similar pattern on a smaller scale. So if I take a look at the 2-year, we are right back up at the Rubicon, and if we can break through, I would expect to get some continuation. The big question is, do we have a catalyst for that? Well, there's a lot of catalysts potentially out there. Russell 2000 just had its worst week in 7, and that would be this week. Let's take a look at the 5-day total, down about 2.5%, so lower than the majors there. And the dollar has been going the opposite way, some would say the wrong way, for risk markets. Here's the Dixie, and this has been going up. And let me show you that on a 3-month chart. You can see that is a lot of upside action there. So that has caused some of the stumbles, or at least been concurrent with some of the stumbles that we've seen in equities a few days this week. And I did mention cyclicals. I want to talk about sector action. It's really been about consumer discretionary this week, and that's again thanks to Tesla. You can see it's still in the pole position, up 0.6%. And Ned Davis Research just came out with an interesting note saying that it is the season for cyclicals. Given the election cycle, the 4-year election cycle, now is the time into the election and then for the following 12 months when you tend to see cyclical stocks like industrials, like tech, and like energy and financials to a degree outperform the more traditionally defensive ones, and that would be like staples, healthcare, utilities, et cetera. So I thought that was pretty interesting. Now let's take a look at the Nasdaq 100. This is the 5-day total. You're going to see more red probably than green. Nvidia, Microsoft up more than 2%. Let's check out what's happening today, and this is a positive note for the markets. Tesla giving back some of those gains that we saw yesterday, but let me just show you a year-to-date chart. Look at that, just pressing up against these prior highs and seeing if it can break through. We got the catalyst yesterday, so we just need a little bit of follow through, up 5% year to date. Guys?
All right, Jared, thanks so much as always. Appreciate it. It's time now for today's strategy session. The sell-off in the bond market showing signs of easing. Our next guest sees the 10-year yield falling back toward 4% after breaching that 4.2 level earlier this week. Joining us for more, we've got Gary Schlossberg. He's Wells Fargo Investment Institute's global market strategist. And Gary, it's great to chat with you. I wonder if you think the bond market is telling us that it's time to de-risk?
Well, I think so. We've had that backup in longer-term interest rates, and there is some concern that with that rise in rates, we could see a slowing economy. And so for a period there, the market may be facing some headwinds. We're already beginning to position, however, for that post-slowdown period. We do look for a growth recovery next year, and our strategy reflects that.
Gary, what does that strategy more specifically look like?
I'm sorry?
What is that strategy if you're positioning for that slower growth heading into the new year? What does your strategy look like? What are some of the positions or some of the changes that you're making?
Well, as I said, we're beginning to look beyond that. We're looking at more of the cyclically sensitive stocks, the sectors of the market, things like financial services, communication services as well, just given the inherent strength there, industrials, energy. Again, looking beyond that slowdown, we're staying away from the defensive sectors of the market. Ultimately, we'll be positioning for a shift toward neutral in small caps if that growth recovery materializes as we think it will.
When you look ahead to fourth quarter earnings for 2024, do you think that the earnings picture that we've already gotten so far indicates more growth heading into year end?
I think it does. The earnings numbers haven't been spectacular, but they've held up reasonably well. All this against the backdrop of an economy that continues to grow more rapidly than expected. Looks like third quarter growth could come in 3% or something north of that. And we did have good momentum going into the fourth quarter based on the recent economic data. Of course, we have the employment number out on Friday, and that could help tell the tale as well.
Gary, what is your assessment of the labor market right now, and I guess how that fits into some of the strategy moves that you are making? How worried are you about some of that softening that has been starting to creep up in those recent reports?
Well, we have seen some slowing in labor force growth, notwithstanding a very strong number for September that we had out last month. However, we do see the economy gradually losing momentum. We think the labor market reflects that. And all that is consistent with that mild slowdown that we're anticipating for the economy as we move into 2025 during the opening months of next year.
I want to end then on what you think about what's going on in gold right now, because we are seeing this gold rally, a little bit of a diversification away from the dollar. Is that about a concern about the potential outcome of the U.S. election? And if that is the case, how worried should investors be about any risk to the dollar as the global reserve currency?
Well, I think the dollar's position as a key currency in world trade and finance is pretty secure. There may be some erosion, as we've seen in the dollar's international standing, but this is really more evolutionary rather than revolutionary, we believe. Gold is being supported by a number of things. There is a little bit of concern that inflation still remains above target. The market is expecting still the Federal Reserve to be cutting interest rates. There are the geopolitical uncertainties out there. Gold really firing on all engines right now. And we could see a pause at times, but the underpinnings, we think, are still very much in place.
All right, Gary Schlossberg of Wells Fargo Investment Institute, thanks so much for joining us.
Thank you.
Coming up, the biggest takeaways from earnings season so far. We're breaking down the top comments from company leaders next on Morning Brief.
We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. So let's kick it off. First up, Colgate-Palmolive shares in the red. The consumer goods giant beating third quarter earnings expectations and raising its guidance. But the company's seen volume and pricing weakness in North America. North America making up about 20% of the company's sales. Interestingly, though, they do continue to see international expansion potentially moving forward, which is a good thing for them because they've got over 20% of their sales coming from Latin America. And I've spoken with analysts before who say that any weakness in the dollar could also be a boon, which we could see moving forward, especially as the Fed continues their rate cutting cycle here.
All right, Maddie, let's take a look at some health insurer stocks, and we're focusing on Centene this morning. Shares are rallying after the health insurer's third quarter profits exceeded the street's expectations, driven by rate increases in Medicaid programs and higher membership in its health insurance exchange business. You're looking at gains of nearly 12% here in earlier trading. This is a very, very strong report. When you take a look at some of the revenue drivers here within this, its commercial side of revenue, that was up 35% on a year-over-year basis. Medicare revenue also rising just above $5.6 billion. That was an increase of nearly 4% from a year ago.
Let's round it out with Microsoft shares continuing to move to the upside. The tech giant CEO Satya Nadella receiving a pay package worth over $79 million for fiscal year 2024. That is a 63% pay bump from last year. And the package would have been about $5 million more if he hadn't taken a pay cut to, quote, reflect his personal accountability regarding some of the cybersecurity risks and hacks that have happened at the company. About 90% of his comp is in Microsoft shares, so you can continue to see this trend of CEO pay being reflected in the AI rally that we are seeing in the broader market here.
We're heading into the biggest week of third quarter earnings season with over 180 companies reporting. The results so far showing three big takeaways. One, companies are focusing on AI spending. Two, financial institutions seeing the need for more rate cuts. And three, it's all about the consumer and the fact that the consumer remains resilient for the most part. Starting with AI push, we spoke to ServiceNow CFO Gina Mastantuono about the growing adoption in AI. Let's take a listen to what she had to tell us.
They're really looking to move from experimentation into implementation, and evolution is likely going to happen fast. Most are realizing if they're not pivoting to broad-based adoption in the next 2 years, they might lose out. And we're seeing the AI adoption curve faster than cloud. I talked about a few minutes ago. It is our fastest growing new product in our history.
Joining us now, we've got Scott Krystoff. He is the founder of The Transcript. It compiles the most important quotes from company earnings calls every week and certainly gets a lot of the funniest ones, in my view. Scott, it's great to have you on. I want to start with your reaction to what we just heard from Gina about ServiceNow and the increase in customers spending big dollars on AI agents. What do you think that tells us about what we can expect on AI spend for the rest of the quarter from other companies here?
Yeah, I mean, I think most companies are still spending, are really interested in AI. I would say the vast majority of companies by numbers wise and trying to apply it to their businesses. And so where we're seeing it spending happen is really in customer service and then also in software engineering from the average company. But then the vast majority of AI spend, as you know, is coming from the hyperscalers and the real core tech companies like Microsoft, Google, Amazon, and others who are spending on the AI infrastructure. And that's where the spend is really going at this point. So the AI infrastructure, I think, is really where the bulk is. And then there's a lot of kind of testing and experimentation among other companies still.
Scott, what are we seeing on return on investment when it comes to AI? Because there was a recent survey out from Morgan Stanley. They spoke to over 400 companies, and they found that 40% of the respondents who have adopted generative AI solutions say that the returns on their investments are actually exceeding their expectations. Is that consistent? I know we're still very early in the earnings season, but is that consistent with what we've been hearing and what you've been really sifting through on earnings calls so far?
Yeah, I think that's not really surprising because honestly, the amount of investment that's required to start to adopt AI tools is not particularly high. I mean, if you're able to access AI tools, for instance, through ChatGPT and OpenAI, that's a major source of AI adoption at this point. And that's a pretty inexpensive tool. So the promise of AI is showing through there that the ROIs should be extremely high, because the cost of AI is very cheap relative to the amount of productivity that it can create. So no, that's not particularly surprising.
Scott, I want to turn over to calls for more rate cuts from companies. Comerica's chief banking officer saying, quote, the feedback that we're getting from our portfolio was that 50 basis points was nice, but not inspiring necessarily. And that really, I think what most of the economies are going to need to see is another 50 basis points to 100 basis points to really see some stimulation there. I know that you've heard some other similar sentiments from other leaders. How many basis points of cuts are these people looking for?
Yeah, I mean, that's a big question. And I think this is a really important quote that you guys are highlighting here, because I think it speaks to the gap between the confidence in financial markets versus the real economy. And I think Comerica, being a regional bank, is touching a lot of small and medium-sized businesses who are depending on seeing the flow through of the actual rate cuts in order to make cost of capital cheaper, in order to allow them to be able to really deploy capital in a way that they haven't been able to in a higher interest rate environment. And meanwhile, if you look at the largest financial institutions, those with more exposure to equity markets, for instance, there's a lot more optimism about how the existing rate cuts are flowing through. But I think everybody is kind of waiting for more rate cuts here. I think even the Fed has just acknowledged that the rate cuts that they've had so far are just to bring us to a somewhat less restrictive stance. They still want to get to a neutral stance. But I think many actors in the economy are looking for a stimulative stance. And so the Fed's hand may really be pushed towards that stimulative stance over time.
Scott, and then also when it comes to the consumer, Capital One CEO said, quote, we see some pockets of pressure related to the cumulative effects of inflation and elevated interest rates. Consumers on the whole, though, are in good shape compared to most historical benchmarks. But there are pockets of pressure. I also got the chance to speak with AT&T's CFO following their earnings results. And he was actually saying that the consumer, from their metrics, that the fact that they're holding up just fine. I'm curious, is the consumer resilience, is that going to be another theme that you think is going to emerge this earnings season based on what we've heard?
Yeah, I mean, I think resilient has been the most used word on earnings calls for the last 2 years now, as we've all been surprised that a recession really hasn't come through despite the higher interest rate environment. The consumer has just continued to spend. And I think what you're really seeing is a continuation of a bifurcation of the consumer, where high and moderate income consumers are still spending a lot, and low income consumers are really under pressure as they've spent through their COVID savings. But at the same time, employment is still high. And so I think what we're seeing right now in terms of consumer resilience is that employment is still carrying the day. As long as people are getting a steady paycheck and feel secure in their jobs, people are spending. And so that is powering the economy. The consumer is really the underpinning force of all of this.
Scott Krystoff, great to have you. Thanks so much for taking the time to join us, founder of The Transcript.
Thank you.
Coming up, Elon Musk reportedly in contact with Russian President Vladimir Putin since 2022. That's according to a new report out from the Wall Street Journal. We are going to speak with one of the reporters who broke that story right after the break.
Elon Musk has reportedly been in regular contact with Russian President Vladimir Putin since 2022. That's according to a Wall Street Journal report. Here to discuss, we've got one of the reporters who broke the story, Warren Strobel, the Wall Street Journal's national security reporter. Warren, thank you so much for joining us this morning on the heels of this reporting. Talk to me a little bit more about what your sources told you about Elon Musk's conversations with Vladimir Putin and the national security challenges that those conversations present.
Sure, and thanks for having me on. What we were told is that Elon Musk has been in regular contact with Vladimir Putin and other Kremlin officials since 2022, right up until the spring and summer. Wide-ranging talks about business, about personal stuff, and of course about Ukraine. And we had two sources who told us that Putin actually asked Musk not to turn on Starlink over Taiwan as a favor to the Chinese president, Xi Jinping. And of course, Putin is in some debt to Xi Jinping for his help and support on Ukraine.
Warren, how do defense agencies and I guess assess maybe some of this risk associated with this? If we have Musk in direct contact with Vladimir Putin, what type of risk does this then potentially pose here, just more broadly speaking?
Yeah, let me make a couple of points if I could. First of all, this is really hard to get because the U.S. intelligence agencies, which I cover, don't spy on American citizens, including Elon Musk. So the information about this was very compartmentalized within the U.S. government. We were also told quite clearly that there was not a counterintelligence risk, meaning that Musk, there was no suspicion that Musk is actually passing or leaking classified secrets to the Russians. The concern more is that there's an unauthorized channel here at the various highest levels of the Kremlin, and that Musk may either voluntarily or involuntarily sort of provide a channel for Putin to get his propaganda out and to get his view of Ukraine out.
I guess I wonder, though, when we talk about, you have this amazing anecdote in the piece about a bottle of vodka that Musk was given by his Russian hosts that had his likeness superimposed on a drawing of Mars, and that followed a vodka-heavy lunch. If you are, as a national security expert yourself, if you're hearing about something like that, then how does the average listener listening to this conversation not be concerned that Musk might be passing on some highly sensitive national security data in some of those conversations?
Yeah, we were, and I want to be very careful here because we're not accusing Musk of doing anything illegal. And we were told that as far as the U.S. government knows, that's not happening. But again, the concern is that Putin and the Russians are very good at manipulating people. Very good. Some people would say they've done that to certain other political figures in this country. I won't name names, but the concern is that they would manipulate Musk in a way where he would do things for them, or some people accuse him, sort of repeat Russian talking points on Ukraine on X and other platforms.
Warren, what about the influence, I guess, beyond this on just geopolitical dynamics? Obviously, when you take a look ahead to the election, when you take a look at Musk's support of Trump and maybe what Musk's role inside of a potential Trump administration, what that could potentially look like, does that at all change the conversation or the narrative or the concern maybe surrounding this?
Yeah, absolutely. And that's one of the reasons, frankly, we thought it was important to do this story. We knew the story would cause a lot of controversy. And we're already getting some hate mail this morning, that we dropped this right before the election in order to influence things. But the fact is, it took a long, long time to put together. But there is, I guess it cuts both ways, to be honest with you. There is concern because Musk has, in the recent months, moved very close to Trump, is now an advisor and chief supporter of his campaign. On the other hand, in the terms of diplomacy, it does open up a channel that one could use. There are not a lot of channels right now between the United States and Russia, which is a kind of dangerous situation for the world's two leading nuclear powers. So, if Trump is reelected, he has another means to communicate with the Russian leader. So kind of double-edged sword, I would say.
Warren, when you're getting hate mail, you did a good story, so congratulations. But I wonder, what did your sources tell you kind of off the record about how they feel about Musk's security clearance and just the level of information that he's privy to given some of his dealings with the federal government?
Well, it was off the record. I couldn't talk about it even here, but we weren't on. I'll be quite honest here. We weren't able to get an awful lot about Musk's security clearance because they don't talk about individual people's security clearance. All I will say is we were given the clear impression that Musk is kind of a special case in the sense that the U.S. government is so reliant on him. for Starlink communications, for launching both NASA and highly classified national security satellites. And he sort of gets, I don't want to say special treatment, but he's in a special category by himself. And that may, we weren't told this explicitly, but it was sort of insinuated that he might get a little bit of a pass on things sometimes.
All right, Warren Strobel, thanks so much for taking the time to discuss your great piece with us. We really appreciate it. Wall Street Journal national security reporter. Thanks so much, Warren. That does it for today for the Morning Brief. But join us next hour for a special edition of Catalyst. We're going to be focused on big tech earnings and what you need to know ahead of a critical couple of weeks here for the market. We've got that for you next. Welcome to a special edition of Catalyst. I'm Shauna Smith alongside Madison Mills. And coming up, we are going to be bringing you full coverage of the Magnificent Seven throughout the program.
The time has come for big tech earnings. We're going to break down the biggest themes that investors are looking for in the earnings results as those market leaders take center stage.
Several members of the Mag 7, including Microsoft, Apple, Amazon, Alphabet, and Meta, are set to release their earnings reports over the course of the next several days. We will be speaking with industry experts to break down the key things you need to watch and know heading into this earnings season.
And we push ahead to the biggest company in the group, NVIDIA. As the all-important AI chip giant ends the Magnificent Seven results, but not for some time. We'll break down all of what you need to know ahead.
Magnificent Seven earnings underway as investors focus on the market's biggest drivers. Let's get to the big picture outlook and the key things that investors you need to be watching for from these big tech results. For that, we want to bring in Nancy Tangler, Laffer Tangler Investments CEO and Chief Investment Officer. Nancy, it's great to have you back. So let's talk about where things stand today. Of course, expectations going into this earnings season is for, once again, these big tech names to really be the driver of earnings growth. Do you think they're going to exceed or even just live up to expectations?
I do, Shauna, and thanks so much for having me. I think when you look at the reliable earnings growers, these companies check all the boxes. And if you're worried about a slowing economy, I'd much rather own these companies than traditional defensive. I think technology, big technology, are the new defensives. And if you look at free cash flow, although they've been criticized for spending, large CapEx budgets, the free cash flow they're producing is unbelievable. It's much bigger than most countries.
So then, is the Magnificent Seven bull rally here to stay, Nancy? And if so, for how long?
So, Madison, I think so. I mean, I don't like all of the Mag 7. We've broadened out our tech exposure and our exposure to other sectors over the last year. But I do think there's a few of the names you just can't argue with. We saw Tesla's earnings. They were incredible. They beat on every metric. My favorite part of the business is the Megapack business, which is the utility grade battery storage business. And that grew at 52%. It's a small portion of the business, but it's the fastest growing, most profitable. So when you look at Tesla being able to beat on earnings, beat on revenues, and expand margins, that's pretty compelling. And so I think you want to own select names. I don't know that you want to own all of them, but I don't think there's going to be any harm because some of them are trading at pretty attractive valuations despite all the hand-wringing.
Nancy, what companies or what stocks are you avoiding in this space?
I mean, we've been 100% wrong about Meta. We owned it for many years and then we sold it, around 300, and it continues to deliver. So that is the one that we don't own. And I'm not going to chase it at this point, but we do own the rest of them. And I think in varying weightings. So NVIDIA and Apple, a medium-sized weighting, Microsoft an outsized weighting, and and Google an outsized weighting, I guess I would say. That's largely due to valuation and the ability to step in. And we'll continue to add to the NVIDIA and Apple as we get the opportunity. We added to NVIDIA in the summer tech swoon, and that was a great opportunity. And so we'll continue to wait and be patient.
And Nancy, Tesla might be it probably is not going to fall into this category. But when you take a look at the rest of the Mag 7, how much of this good news has already been priced in given their current valuations?
Yeah, so I was pretty pessimistic. I went to We Robot. I was sort of nonplussed as a Tesla investor. And I was a little bit pessimistic, though we still own it. And clearly everyone else was because the stock shot up on the news. So I think, that there is a risk that you'll see a name like Microsoft beat, which they do about 76% of the time on earnings historically. And you may get nothing out of the stock price. It's been trading sideways for the last all year, actually. But at some point, the catalyst will kick in. And it's been trading that way because people are worried about the CapEx budget, but it's still producing in 2024, $74 billion in free cash flow. So that's after the CapEx. And so they're growing the dividend, and you can just kind of hide out in Microsoft, in my view.
Well, Nancy, you teed me up perfectly. I am curious, what is the single biggest thing that you want to be watching out for heading into Microsoft's earnings?
I think we're going to be focused on, Azure, as is everyone else. Is it going to continue to accelerate? It did last quarter, and they got nothing for it. We're going to be looking at margins, and then, just the guidance for the future, because I think, they announced their CapEx budget. Wall Street didn't like it. Wall Street analysts don't run businesses. Satya Nadella does, and my money's on him. So I think we want to hear the monetization of the AI. Just forgot the name of it. Their AI chatbot and Copilot. Sorry, and we will see how that is going, because that's the criticism on AI, is that it has not been monetized.
Nancy, that happens to me all the time, so don't feel bad at all. When it comes to the performance that we've seen from Microsoft stock since the start of the year, we're looking at gains of just about 14%. Now, that far underperforms what we've seen just in returns here compared to the broader S&P 500. Is this earnings season, is that going to be the catalyst to really get Microsoft back on track?
No, Sean, I think largely it will probably be driven by Azure and monetization of AI. And so if they give good guidance on that, I think the stock will have an opportunity to appreciate. We were adding to it went right before the new bull market started at $200 a share, $214, $215. And that's a great generational opportunity. So it also matters, of course, where you got in, how patient you're willing to be. But they're growing the dividend 10% a year, even though the yield isn't, super high. You get that growth as an offset against inflation, and so I think you can be patient. We'll see. They've, when they report, they usually outperform the majority of the time after the report.
All right, Nancy Tangler, great to kick this off this special with you. Thank you so much for taking the time to join us here this morning.
Thanks, guys.
Coming up next, we are doing a deep dive into Meta, Alphabet, Amazon, and more. Stay with us. We'll be right back. Turning now to focus in on three members of the Mag 7, Amazon, Meta, and Alphabet. With a combined market value of more than $5 trillion, these three tech juggernauts dominate across e-commerce, social media, and search. To discuss, we want to bring in Mark Mahaney, Evercore ISI's Senior Managing Director, Head of Internet Research. Mark, it's great to have you on, and you're the perfect person to talk about these three names. So let's kick off this coverage with Alphabet. A lot of eyes are going to be focused on what exactly we are hearing from Google's parent company. Of course, it's everything from Google Cloud all the way to the advertising revenue. I'm curious, what is the number one or maybe the top factors that you will be looking for in this results?
I think it starts with search and it probably ends with search. So can they maintain search revenue growth, kind of double digit, solid 12, 13, 14% search revenue growth year over year? Does the outlook continue for that? Second is YouTube. If there was one weakness in the June quarter, and like generals, investors always battle the last quarter. The softness last quarter had to do with YouTube, which came in a little light. So does that turn around or not? And if it doesn't, why hasn't it turned around? It's not like it's declining, but the growth did come in light. And so that would be the secondary issue. And then third, there is a broad expectation in the market that the cloud companies will be able to print accelerating revenue growth in the back half of this year because industry cloud demand is accelerating. So Google Cloud should show that. By the way, so should Microsoft Azure, and so should AWS.
I wonder what you think, Mark, about the AI goodness. It feels like Google has not had the first mover advantage on that. What do you expect to hear from Alphabet's earnings specifically on AI?
Well, they've been talking about how they're trying to infuse AI into all their products and services. I mean, I think you're seeing it in AI overviews or in Google Gemini. And then I think you're seeing it also from a marketer perspective. So not too many consumers see this, but in terms of the way that they're able to help marketers and advertisers better target, better manage ad campaigns, better drive attribution, and all of that should lead to a higher return on ad spend, which should lead to continued kind of robust ad revenue growth across the board. So I actually think Google's done a decent job with AI. They've been investing in it for, 7, 8 years or something like that. I think they got caught a little bit flat-footed by OpenAI, but my guess is that they have the ability to easily catch up to where OpenAI is.
Mark, let's zero in on Meta. Meta has certainly been an outperformer among the Mag 7 companies since the start of the year. We're looking at gains of over 60% since January 1st. Of course, a lot of the focus is going to be on CapEx spending plans, what exactly we're going to be hearing from Zuckerberg on the call or some of the other Meta executives. Is this the type of momentum that you see continuing here after third quarter earnings results, or is this a risk here of almost a catalyst to the downside?
It's probably more the latter than the first. There's this mean reversion trade that, I think is a probability with this name. Look, I think fundamentals are well intact with Meta. Is it actually the best performing of the Mag 7? I guess it probably is. I don't know. Probably not with NVIDIA, but I don't cover some of the other names. But in the internet space, the fundamentals have been amongst the most and probably the most impressive in the advertising space. I mean, especially at their scale, they're doing well over 20% revenue growth. That is truly impressive. I think there's a lot of kind of untapped areas, threads, click to message ads, WhatsApp, Facebook Marketplace that they can still kind of lean into to sustain what I would call premium growth, mid-teens, maybe even high teens over the next couple of years. Margins are rising. So the expectations are high for this stock. I think they'll be able to deliver against them. I like the stock. It's not one of my top picks because it's not that dislocated right now. It's not dislocated at all. It's probably the most consensus long in large cap internet. But maybe the one trick or one thing, if the stock were to trade off, it would probably be because the company were to surprise people with a really aggressive CapEx outlook for next year. I think that's a possibility. I don't think that's the probability, but I think it's a possibility that happens.
Well, and given that Meta has found a lot of success by being really defensive on the balance sheet, I wonder, too, what you think we're going to learn about their expenditures when it does come to AI. Do you think that we will get any indication about any ROI on their AI spend this cycle, or will we have to wait?
I think we'll get it. I think we've gotten it. The last 2 years, if you look at the ability of this company to recover to almost 30% ad revenue growth, that came because of AI. They used AI to rebuild the user interface to make it more of a media platform rather than a social platform, and they used it to dramatically improve the ad targeting, campaign management, ad creative for marketers, and that's why Meta right now is perceived to be kind of the easy buy amongst marketers, amongst advertisers. I think they'll be able to give you more and more data points that prove that they've been able to effectively, with a good ROAI, they've been able to effectively invest in AI, which is one of the reasons why I think they've been so successful with it, that I think they may well decide to even more aggressively lean in. I don't think any of these major internet tech companies, the big ones, Amazon, Google, and Facebook, Meta, I don't think any of them are going to step back and say, hey, we're cutting back our AI CapEx. They're either going to keep it where it is or they're going to accelerate it even more. And that could be a little bit of an issue for investors.
Mark, zeroing in on Amazon, I know it's your top pick within your coverage list right now. You've got a 240 price target on the stock. Explain to us or break down that bullish call and why you're so confident in Amazon at this juncture.
I think Amazon can go higher if AWS growth continues to accelerate, high margin business, large TAM, market leading position. If they can kind of prove that 2 years ago, the narrative was they were losing share to Microsoft. If that narrative changes, and it would change if they continue to show accelerating revenue growth, I think that helps takes the stock higher. If retail sales growth for Amazon, kind of around 10%, kind of stays consistent, there's no real sign of consumer softness at Amazon. And if retail margins continue to rise, the trick here is they're investing a lot in this new satellite communications initiative called Kuiper, which is kind of a competitor to Starlink. So investors are going to want to know what's happening to the core retail margin trends ex Kuiper. If they can show those to be steadily, consistently, solidly rising, I think if you put those 2 or 3 elements together, the stock goes higher. That's why it's one of our top picks. It's why it's our top pick.
Yeah. Mark, let me get 30 seconds from you on AWS, making up about 17% of the business, I believe. What do you expect to hear from them about growth moving forward?
Acceleration. So they did 19% year-over-year revenue growth last quarter. That number's probably 21% this quarter. And it's because we're behind the optimization cycle, because AI workloads are leading to more requirements or more business for storage and compute, and because corporations as a whole are re-engaging with cloud computing. We should see acceleration from AWS. By the way, if you don't, I think that'd be a real negative catalyst for the stock.
All right, Mark, we got to leave it there. Thank you so much for joining us. Appreciate it.
Thank you.
Coming up, we're diving into Apple and NVIDIA. Stick around for that next, right here on Catalysts.
Apple's quarterly results providing insight into the company's debut of its iPhone 16 and initial sales from that release. The company also releasing its long-awaited Apple Intelligence software. Here to break it all down, we want to bring in Ramon Alamas. He is IDC's research director. Ramon, it's great to have you here on Yahoo Finance. So there's been some worry, I think, out there just about demand and what exactly that looks like for the iPhone 16 this quarter and going forward. How do you see that shaping up?
I think we're still very much in the early innings of the iPhone 16. Look, there's a lot of things going on with the iPhone 16 that makes it really wonderful. I mean, one of the things is the camera. A lot of it is the interface. But you got to also realize that, people are taking their time replacing their phones longer than they used to. I mean, way back when, it used to be almost like every other year. Now it's coming up to about 3 or 4 years. And now that we have to wait for Apple Intelligence to come out next week, it wasn't ready, as soon as, out of the box. So I think there's going to be some tempered, patience over there. But I think people eventually are going to come, especially with the holiday quarter bearing down on us really soon.
Well, Ramon, given that AI is obviously a very new technology, what do you look at to suss out whether or not that AI software, once it is released to Apple consumers, is going to be enough to get people to potentially say, okay, this will be the thing that gets me to upgrade my iPhone early? What if it is just different this time?
Well, I think there's several things you got to look out for with any new technology that not just Apple, but almost any company is going to come out with. Number one is going to be convenience. Does it make my work or does it make my life a lot easier than it used to be? Do I have to just do one click or do I have to go through 5 clicks? So that really helps. Number two, is it just going to be, very intuitive? Is this going to be something that I don't really have to think about? I can almost do it, blindfolded. Is it going to be, that easy? But, the third thing that I'm really looking for is, how is this going to benefit, people's lives, which seems to be the thing that comes out. Hey, it's great that AI and Apple Intelligence specifically is going to make, a lot of processes easier. But when you look at the, average consumer who says, well, I can take a picture, no problem. I can, draw a text, draw a picture, write a text, pretty easily. How much easier is this gonna make it for me? And if Apple can successfully answer those questions, then we're going to move on to the next piece. There's adoption, then there's usage, then there's, sustained usage. And so those are the kind of the 3 things that I'm looking at, as, the months go by after AI launches.
Ramon, there was a recent downgrade here on Apple, and one of the issues that the analyst there was calling out was some of the unrealistic expectations, and he was focusing on those unrealistic expectations to reaccelerate growth across all product categories and all geographies. I'm curious, do you see that being a challenge, or how big of a challenge do you see that being for Apple over the next several quarters?
Well, there's a lot of pressure put on Apple right now, especially in light of, some of the recent products that came out this year. I mean, a great example is going to be Apple Vision Pro. A lot of folks who are saying, hey, this is going to be the next, growth generator for Apple going forward. They're going to sell millions of units. And, from where we're sitting, that really hasn't happened. Even after, it launched in the U.S. in February and then came to, several markets across Europe and others, later on in the spring. This was not a million unit mover, kind of like we've seen with the iPhone and the tablet and the watch. So when you kind of put it all together, a lot of people are saying, some of these things that we've been seeing and waiting to come out, have they been, lighting the fire as much as we thought it would? No. Okay. But, I think, we're still very much in the early innings, especially with something like AVP, Apple Vision Pro, where, can we judge the entire future product line on just its first initial one? Absolutely not. Because if you take a look at Apple's history, Apple iPhone, the first time it came out, it barely sold 500,000 units. Same thing with the watch, same thing with the iPad. So we're going to look at, what that next iterations are going to look like, how Apple's going to look to innovate and improve what they've already done. And also, most importantly, how those prices are going to change. Because if you take a look at an Apple Vision Pro, that's several $1,000s that not a lot of people have ready to spend. Looking at something, say, $2,000 or lower, perhaps that's something that more consumers could gravitate towards.
Ramon, before we let you go, what is the single biggest thing investors should be looking out heading into Apple's report?
There's the single biggest thing for me is going to be, the iPhone, because again, that always accounts for about, 67 to 70% of total revenue each time that you look at it. But take a look at how services are slowly growing. I mean, over the past couple of years, it used to be the number 3, revenue generator. Now it's the number 2, and that margin is growing much, bigger compared to the iMac and the iPad and the wearables lines. So it's one of those services that Apple has to offer, where it almost literally prints money. And I'm not saying that Apple has to introduce new services. I think what they are to do is reach into its base and get more of its current users more invested into those services, saying, hey, we have storage, we have photos, we have a lot of things here for you that we could help make your life a lot easier. So keep an eye on how much services continues to grow, and how much it's going to have a spread compared to some of the other product lines.
All right, Ramon, thanks so much for joining us. We appreciate it.
Thank you.
And last but obviously not the least to report, we've got NVIDIA, the AI chip giant with a market cap greater than $3 trillion, will close out the Magnificent Seven, reporting towards the end of November. Joining us for more, we've got Toshiya Hari. He is Goldman Sachs head of U.S. Semiconductor Research, and he holds a buy rating on NVIDIA. Toshiya, it's always great to speak with you because you have such great insights into NVIDIA. I know that you recently met with Jensen Huang. You also had him speaking at the Goldman Tech Conference earlier this year. What is the biggest thing that you learned from those conversations that is going to impact your thinking heading into NVIDIA's print?
Of course. Thank you so much for having me, Madison. You're right. We did have Jensen attend our conference in early September. We were also on the road with him and the rest of the team very recently. Look, there are a couple of things. First, in terms of the demand profile out there, the environment continues to be very robust. If there's a problem, it's a supply problem, not a demand problem. You've got the large hyperscalers, which we will hear from next week from a couple of them. They're still in the early stages of the build out from an AI infrastructure perspective. The customer profile is broadening beyond the hyperscalers into enterprises and also sovereign states. So there is demand across the board there. Secondly, I think there's been this perception historically that NVIDIA is very strong in training, yet their competitive position could potentially dilute as we transition to inference. As you look at the most recent models that have come out from OpenAI, the complexity from an inference workload perspective is going up, has gone up. And as that proliferates to other models, we think that will only grow NVIDIA's growth opportunity set and potentially expand the competitive moat that they have. So again, demand very strong, competitive moat very sustainable as well.
Yeah, so Toshiya, it sounds like you're saying that any concern almost of the fact that NVIDIA could be slightly losing their dominance, or the fact that some of these smaller players are gaining maybe more of a competitive edge or better able to compete with NVIDIA, it doesn't sound like that's worrying you at all.
It's something to definitely keep in mind and to be cognizant of. And there are a handful of startups that are making really good progress. There are other merchant companies as well that compete effectively with NVIDIA. But when you think about NVIDIA's ability to really innovate across multiple components, if you will, it's not just the GPU. They've got their internally designed CPU, the Grace CPU. They've got NVLink, which is a switch that essentially connects multiple GPUs. They've got Ethernet connectivity. They have InfiniBand connectivity, and obviously they have a very broad suite of software that augments their hardware capability. So when you think about their breadth and their ability to innovate at a 12, 18-month cadence, I think it's going to be very difficult, very challenging, and expensive for others to compete head-to-head with NVIDIA.
I want to get your response, Toshiya, from two things that analysts we've spoken with have called out in a somewhat bearish case on NVIDIA, though you can't really be bearish on NVIDIA right now. But they've talked about the potential competitors, something like a Cerebras, for example. They've also talked about the potential slowdown in demand if we do have a macro challenge moving forward. Which of those two do you think is more likely, or do you think that neither one is actually going to be that big of a headwind for NVIDIA?
Yeah, it's a great question. Between those two, Madison, I would say the latter probably comes up more and more in our conversations with investors. Again, I don't think the company is complacent in any way. They are very paranoid when it comes to competition. But again, the bigger debate is really how to think about sustainability of demand going forward. The majority of investors, we believe, are fairly comfortable with the outlook going into calendar 25. The big question mark is calendar 26. To the extent CapEx continues to go up at the hyperscalers, potentially negatively impacting their gross margins, their free cash flow, what does that mean for 26 and beyond? So between those two, Madison, I would be a little bit more concerned about the latter. But again, at this point, we remain pretty positive on the stock and on the trajectory going forward.
Talk to me about what you've heard from those hyperscalers about their CapEx when it comes to NVIDIA. There's been this big question about whether or not we're going to see a return on that investment from hyperscalers. What are you hearing about that?
As of now, Madison, I think, again, as a group, as a cohort, the hyperscalers are very much in build mode. Our colleagues' capital spending estimates for calendar 25, the bottoms up number is suggesting sort of mid-teens to high teens growth. We do think, based on what we're hearing from customers and partners and the supply chain in Asia, there's probably more upside risk to those numbers. So again, we'll find out as we progress through next week and a couple of the big customers report. We do think there's potential upside there. Again, the big debate is not so much calendar 25, it's really calendar 26. At this point, it's very difficult to prove or disprove where things are headed beyond 25. To the extent we're sitting here in 6-12 months and the monetization is not there, the ROI is underwhelming, increasingly we would potentially become a little bit more worried about not just NVIDIA, but the companies that really make up the ecosystem from an AI infrastructure perspective. But at this point, again, we remain very constructive.
So Toshiya, what does that tell us about where the stock's headed? I'm guessing it's headed higher in your view, and you see new all-time highs on the horizon.
That's right. We do expect upside from here. When we compare and contrast how we're thinking about the 25 earnings profile, the margin profile for the company relative to street consensus, we're modeling about $4.65, give or take, in EPS for calendar 25. As of this morning, I believe we're about 15% above street consensus. So, again, we have about a month left until the company reports. But as we progress through earnings season, we hear from the hyperscalers, we hear from NVIDIA in a month's time. We would expect street numbers to move up and for that to drive the stock higher as well.
All right, Toshiya Hari, Goldman Sachs Managing Director, thanks so much for taking the time to join us.
Thank you.
Now, we've heard from several analysts and experts discussing those Mag 7 names. Let's get to some of our key takeaways. And Maddie, for me, it was all about the bullishness that we've heard consistently over the last 30 minutes. We talked to portfolio managers, we talked to analysts who specifically cover these names, and almost every single one of them were very bullish just about where AI spend is headed. And I think that was one of the concerns, if you can call it that, going into this earnings season, is whether or not these results were going to live up to expectations, the risk that maybe we could hear from some of these hyperscalers, the potential here for them to be pulling back on some of their AI spend. But if you listen to Mark Mahaney, who covers a number of these names, he was very bullish on what that was going to look like. And then even the NVIDIA analyst that we were just talking to there from Goldman Sachs, just really making the case that NVIDIA is well positioned. They're a very dominant player within the space, and he doesn't see the risk of any AI spend slowing down, at least looking ahead until 2026.
If there's any risk, it's to the upside, is what he was talking about, and the importance of this kind of competitive mode around NVIDIA as well, that the company is paranoid is the word that he used, which I thought was fascinating, about any competition, so that's not the concern. It's also interesting how much the macro environment doesn't seem to be a big issue. He talked about the importance of that as a potential risk for NVIDIA, but saying again that that's not going to come up until 2026 here. Also, he was just on the road with Jensen Huang, which, I mean, that's cool. It would have been fun to talk to him about that celebrity sighting and what that was like. But and just the degree to which Jensen talked about the competitive moat that the company has moving forward. It seems like the hyperscalers who might have gotten dinged by Wall Street for their increased AI spend, they're saying, well, whatever, we don't care. We're still going to continue to spend on it because this is the future.
Yeah, and also the big company we haven't talked about yet is Apple. And we talked to Ramon Alamas over from IDC Research about his expectations heading into that and some of the questions or uncertainty surrounding what demand was going to look like. And he was actually relatively optimistic just in terms of what AI is ultimately going to be in terms of a driver here for Apple going forward. You talked about maybe some of that uncertainty when it comes to services, revenue, services growth, and what exactly that is going to look like when the key parts that he is looking for in this earnings report. But again, when you take a look at that one-year chart of Apple, you're looking at gains of just about 35%, is trading above 232. So the street remains optimistic about what we are going to hear from them over the next several days.
And what he said too, just about how it depends on how good Apple Intelligence is and like how much more productive it makes individual consumers. If people love it and are talking about it a lot online, then maybe it does lead to a huge gain in sales. But if it's just kind of a little bit of AI cherry on top to make investors happy, then it's probably not going to lead to this huge surge in sales.
Going to be a wait and see to see how everyone reacts to it. All right, well, coming up next, we will be looking at some of today's biggest market drivers. On the other side, we'll be right back.
Let's get to some economic data crossing the wire this hour. University of Michigan's consumer sentiment edging higher for the third straight month, now at its highest level since April, coming in at 70.5 compared to expectations of 69. This month's increase was mostly due to better buying conditions for durables, in part thanks to the easing of interest rates. Still, the presidential election looming over consumer expectations here. The share of consumers expecting a Harris presidency fell in the survey data from 63% last month down to 57% in October. Sentiment amongst Republicans also rising here, so that was interesting to note. But also peeling back the year-ahead inflation expectations, I thought were interesting, down to 2.7%. That's the same as last month, but at least they're holding on to that 2 handle, which is what the Fed is looking for.
Yeah, and I guess that's a bit of an improvement there. And I think overall, when you take a look at this maybe steady, sluggish, slow climb to the upside, obviously things are improving, the highest number that we've seen since April, like you said. But still, though, it's well below those pre-pandemic levels. And I think that's critical just in terms of as we gauge how much progress has been made, how much more needs to be done in order to hopefully return some of these sentiment levels back to what we had seen pre-pandemic. Clearly, these levels that we are seeing today still well below what we had seen a few years ago. So the situation is improving, but still a ways to go. And I think that's also reflected in much of the economic data that we have been getting, which has been mixed. There has been fits and starts in terms of significant improvement. But then, of course, we've gotten these weaker results that put a lot of that into question. I think much of that is being reflected in some of the sentiment survey data that we are getting as well. Let's take a look at some of today's top trending stock tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. That's with Yahoo Finance's trending tickers page. First up, fast food companies pulling onions from select restaurants following an E. coli outbreak at McDonald's, likely linked to the vegetable. Now, Burger King, owned by Restaurant Brands, is removing onions from 5% of its restaurants after determining those onions came from the same farm as McDonald's. Yum Brands, a parent company of several chains, including Taco Bell and KFC, did not specify how many restaurants were impacted, but they did say that they are proactively removing them out of an abundance of caution. You're looking at Restaurant Brands under just a bit of pressure here this morning. Yum Brands still holding on to slight gains. Again, this is being done out of an abundance of caution from both companies here. They're not citing any sort of E. coli outbreak or anything like that. But again, this really points to the fact that how maybe at risk some of these companies are because of this outbreak, what ultimately that could mean. Of course, we are waiting for updates from McDonald's. We saw that severe reaction in their stock price earlier this week following the E. coli outbreak when the number of cases kept climbing. Of course, there were initial comparisons to maybe Chipotle, what happened back in 2015. It seems like at this point we're still a long ways away from making those direct comparisons. But again, some of that uncertainty and some of those questions did start to creep up into the markets. So of course, some of their competitors out there are taking proactive steps to hopefully avoid a similar type of situation.
Yeah, certainly. And it's interesting to see kind of Wall Street's reaction because we do have some analysts maintaining their outperform and buy ratings on McDonald's. That's the case with Wedbush and Gordon Haskett, but TD Cowen's got a hold on the name. Bernstein with that market perform following the news. So we do have, and Baird, of course, who I believe was one of the first following the E. coli news to drop their rating on McDonald's. So it's interesting to see those analyst ratings coming in, even though we still don't know if this is comparable to what happened with Chipotle. So potentially could be seen in, as we move forward, as a little bit of an overreaction, but it just depends on the extent of this outbreak, which we are, of course, still monitoring here. Next up, SoFi Technology is getting a boost from strong results from Lending Club, saying they are seeing bank partners return to the loan marketplace for the first time in about 6 quarters. SoFi is set to release its third quarter earnings next week. And I just want to take a look at SoFi shares over the past couple of months here, if we can pull up a 6-month chart, because it's been interesting to see just the degree of the run-up that SoFi has had over the last couple of months as we do head into that earnings print. You can see year to date, they're not up too much, but if you take a look at the last 6 months, there's certainly been a rally in SoFi shares. And I know, Shauna, that you were mentioning this story this morning just about the degree of movement to the upside in Lending Club and how that has led to a bit of a sympathy move to the upside for some of these other names.
Yeah, Mizuho analyst Dan Dolev was out with an interesting note that caught our attention. And he was just talking about the results that came out from Lending Club, maybe exactly what this signals for SoFi. And he actually brought up the recent stock action, what we have up on the screen right there. And he said that he's being mindful of the recent rally in SoFi shares, but he did note that Lending Club stock has actually performed far better. So therefore, that lends him to believe that any signs of improving trends could then drive a re-rating, meaning that investors could come to assign the stock to a higher multiple, which then could ultimately drive shares to the upside. We will be hearing from SoFi when they release their results next week. That will give us clearly a better picture, a better idea of the strength of the consumer, the resilience of the consumer. One of the trends or one of the common 3 threads that we have talked about here throughout this earnings season so far. So whether or not the consumer continues to hold up and what that strength looks like, I think could also be indicative maybe of what some of that spending power looks like then going forward.
Absolutely.
Let's take a look at Mercedes-Benz planning to step up cost cuts after earnings halved in the third quarter. That was due to weak demand and competition in China. The luxury car maker cutting its full-year profit margin forecast target twice during the quarter. It joins a growing list of European automakers blaming a weakening Chinese market for falling profits and also for weak margins. When you take a look at some of the efforts here from Mercedes going forward, or some of the troubles, I should say, they said that the weakness due to that softer pricing, the lower sales of its higher margin cars. The division's margins actually fell to 4.7%. That was down from 12.4% a year ago. So really illustrating the massive drop that we've seen in margins. Obviously a very worrisome sign for not only Mercedes, but many of its competitors within the space as well.
Yeah, that's a great point, because we saw a company like Tesla having strong results a little bit off the heels of impressive sales coming out of the China region. That's not necessarily going to be the case for these other automakers. And we've heard the Chinese government over the course of the last several days also saying to to their own automakers to have the walls up a little bit, as the EU is considering further regulatory pressures that could lead to more tariffs moving forward here. So this challenge that came up in Mercedes results is only potentially the beginning. It's not just dealing with the economic slowdown in China. Germany itself is also in deflationary territory, which does make up a significant portion of Mercedes sales as well. So that could be another reason to see some of this pressure. Mercedes talking about cost cutting, but the degree to which they're able to cut costs to meet the macroeconomic slowdowns that we're seeing globally remains to be seen. All right, well, coming up, we've got more in the auto space. Volkswagen bringing back Scout Motors, unveiling its first EVs. We're going to talk to Scout Motors CEO Scott Krystoff about what is happening next for the brand on Catalysts.
Volkswagen-backed Scout Motors revealing its first new vehicles in over 40 years, a hybrid electric pickup truck and SUV, both expected to go into production in 2027. I want to talk about this with more with Scott Keogh. He is Scout Motors CEO and our very own autos reporter, Pras Subramanian, joining the conversation. Thanks to you both for being here. Scott, it's an exciting day. Congratulations on the releases that you're having this week. Just talk to us about the strategy going forward here from Scout and the inclusion that you seem to have with this gasoline-fueled ICE to the mix, adding it, and why that makes sense when you look to expand your footprint here in the U.S.
Look, I think a couple of things. First of all, it's the return of an iconic brand. It basically made the SUV back in the day, and now it's returning, and that's a lot of excitement, a lot of heritage behind that. In terms of how we're going to market, I think we have two powertrains, right? We have an electric powertrain, 350 miles, and then we've got a range extender. And I think it's the perfect technology for what's happening in America today. It gets you up to over 500 miles, gas generator powering the battery. It introduces electrification to America. That gives you the safety and security of a gas-powered engine. It gives us the flexibility in our plant and in our platform. So for us, it's spot on.
Hey, Scott, Pras here. So, I was surprised to hear about the range extender option, the Harvester, with the inclusion to that with the vehicle lineup. Were customers asking for that feature exactly?
Yeah, Pras, it's a good question. Look, we had looked at it previously. Maybe it was a little bit on the back burner. About 9 months ago, we put it on the front burner. I think that's the great thing about being a startup that can pivot fast. We got our engineering in Novi, Michigan. The team turned. They came up with a brilliant solution. And I think the customer is looking for it. It's a good solution, and it gives us the flexibility, which is what we want.
Looking at those two vehicles behind you, very attractive automobiles, actually. But one of them kind of reminds you, there's a little bit like of the Rivian pickup, just a little bit. But I wanted to ask about that Rivian connection of VW and Rivian now with the big joint venture. I noticed the zonal architecture being used in these trucks. Is that part of that Rivian deal? Is that sort of that knowledge transfer?
Yeah, I think two things. One, I can promise you these cars are not Rivians. Solid rear axle, body on frame, proper old school truck. So it's a whole different thing, in my opinion, different target group. That being said, look, I think there's Rivian, the car company. Let's put that in a separate place. Then there's the joint venture. So yes, there is the possibility that Scout will have the joint venture architecture in our car. As you said, modern, zonal, over-the-air updates. So it's a great opportunity for Scout, no debate.
Scott, how quickly do you see your footprint and your presence growing in the U.S.?
Look, we're going to come to the market in 27, and we want to grow as quickly as possible. But I think the most important thing is to get the business case right. And there's two things to get the business case right. Get material cost of the car down so we can make money on car number one. Critical with an EV. And then being a startup, obviously, we don't have any legacy costs. We don't have big overheads. We can manage our operating costs. So we think we can ramp up quite quick. And judging by last night, we had 600 reservations coming in almost every 45 minutes. So I think there's good excitement. So we feel good. But one step at a time.
Scott, talk to me about how you're navigating your strategy behind pricing, because obviously that's something that has been a headwind for you and many of your peers out there just in terms of making these cars profitable. I know you have a very quick turnaround timeline in terms of your expectations to become profitable on these cars, but walk us through that strategy and I guess where you see really the sticking point here for your consumers.
Look, I think, you have to watch cost and you have to offer Americans value. It's not new news from the front that Americans want a good value. That's why it's one of the most price competitive markets throughout the world. So we're cognizant of this from the first second. Look, I think we have two advantages. The classic problem a startup has is they can't get material costs down. They don't get good terms of trade with suppliers. The classic problem big OEMs have, of course, is they've got legacy cost and overhead cost. The fact that we're able to use the startup advantages with the bundling from the Volkswagen Group to get costs down really gives us a slick business model, which is why we can turn profitability relatively quick. Material costs are right. And as you know in the automotive business, if you don't get them down when the car is in manufacturing, you'll never get them down. So we have them at a good place right now. We feel good about it. Obviously more work to do. But if you get the material cost right, you can offer great value. And I think if you look at these cars behind me, 1,000 pound-feet of torque, massive credibility. To put these in the marketplace in the high 50s is unreal. This is going to be a highly valuable car, and this is pricing, honestly, in 27. So that's 3 years out on inflation. So quite competitive pricing we feel we have.
Hey, Scott, I know you've said in the past, I want to verify that you think that you might hit profitability in that first year of sales in 2027. I just want to verify that. But also, you mentioned, I think, every 45 seconds of pre-order. Can you talk to me about how many pre-orders you guys have accumulated so far?
Yeah, I went to bed late last night and it was quite good. I got up early this morning. I didn't check them, but we're feeling really motivated by it. In terms of profitability, first full calendar year. So obviously we'll ramp up, we'll get stabilized, and then we're able to get it from there. Of course, if the demand holds and all that holds. But we've watched our cost, we've watched our overheads, and I think we're in a very good position for how we're going to market. And of course, it helps to be in the healthiest, most profitable segments, basically in the global car market. This is what Americans looking for, and these are good, healthy segments. That's why we're here.
Scott, you used to be head of Volkswagen US, kind of covering all different bases beyond trucks and other vehicles. Yeah. What's your sort of 30,000-foot kind of viewpoint of the auto market right now? A lot of trepidation here with the consumer and changing sort of powertrain structures. What are your sort of overall thoughts here on where the auto market is going now and kind of going forward?
Yeah, you know, you hit it right on. I think what the industry is spending too much time doing is talking about all of our problems. And when you talk about all of these problems, from mandates to China to semiconductors to geopolitics to pricing going up and down to inflation, the consumer loses trust. That's what ends up happening. And then what they lose is excitement. So I think we want to simplify this thing. We want to bring trust back to the market and bring some excitement back to the market. The industry should be talking about the cool things it's doing, not all the problems it has. I hear executives talking about Darwinian times, and the consumer is not interested in Darwinian times. They want something cool. So we are laser focused, get the cost structure right, and do something cool. I also think there's this moment in America where people want to build things again. They want to do things again. I think that's why there's this visceral reaction to Scout. It's like, yeah, we should build things again. We should offer great jobs to Americans. We should bring these things back. So this heritage revitalization with the backing is a good play, and consumers are reacting. So it's quite powerful.
Scott Keogh, we really appreciate you taking the time. Thanks so much for joining us here on Yahoo Finance. Again, congratulations.
My pleasure.
On the announcement this week. We look forward to having you back soon. And of course, our thanks to Press.
Thank you very much.
As well.
All right, great interview, you guys. Let's do a quick check on the markets before we round out our show. You're still looking at gains across the major averages. No surprise that tech is the biggest gainer right now in the S&P 500. If we can pull up the major averages from the control room here, you've got the S&P up 0.7%, the Nasdaq up nearly 1.3%. We will see if the market is able to maintain its 6-week winning streak. It does look like right now it is still on track to snap those 6 weeks of gains.
Coming up, it's Wealth, dedicated to all of your personal finance needs. Alexandra Canal has you for the next hour. Have a great weekend. We'll see you Monday.
Welcome to Wealth. I'm Alexandra Canal in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, we've got another busy week of earnings coming up. A portfolio manager will break down the key stocks to watch. And 'tis the season to look for a seasonal job. We'll dive into everything you need to know about navigating the competitive holiday hiring season. Plus, what's the best piece of financial advice you've ever received? For one of our recent podcast guests, it was a few words from someone you may have heard of before, Jeff Bezos. We'll dive into the lesson he learned and how you can use it to shape your financial future. But first, we take a look at some of the market action 90 minutes into the trading day, and we're looking at gains across the board here with the tech-heavy Nasdaq Composite up about 1.4%. The benchmark S&P 500 is up around 0.8%, while the Dow has added around 120 points so far in the trading session. Joining me now to discuss where markets could be heading is Jeremy Bryan, Gradient Investments Senior Portfolio Manager. And Jeremy, it's been an interesting week, right? We had Tesla earnings surprising to the upside, but the S&P 500 is actually on track to close the 5-day period lower, so breaking away from that recent streak of wins. What's your bird's eye view on the current state of the market and where we could potentially end up by year end?
Yeah, I think overall, the general trend has been higher. Right. Every time we've had any period of underperformance or a losing week, it's usually been followed by a rallying week the next week. So I think the general upward bias still kind of continues into year end, just simply because we don't have a lot of significant catalysts. We'll see what earnings hold for the remainder of the session here. But outside of that, there aren't a lot of significant catalysts that could really derail the market trends that we see right now. And as we look into 2025, people are still relatively optimistic. So I think our trend could still be flattish to upward from here. I wouldn't expect the same level of, hockey stick type of growth that we've had, but we could still end up higher than where we are right now.
You mentioned earnings, and we're right in the thick of earnings season. We have those big tech giants coming up, Apple, Amazon, Intel, Meta, all reporting next week. How's your positioning on big tech? Are certain names overvalued, and is AI or the promise of AI really enough to justify some of these levels?
Yeah, I think it's company by company. In certain areas it is, and in certain areas it might be a little bit more difficult. From our side, I think the biggest way I could say that is in our positioning on Microsoft versus Apple. We are overweight Microsoft, and we're actually fairly positive on that one coming into the quarter. Whereas Apple, we are underweight. And the reason for that is AI focused, if you will, is that we believe Microsoft is at the forefront of artificial intelligence approaches, use cases, and really kind of the beginning component of how we're going to use this more frequently in the future. Apple's a little bit more dicey with regard to what the rollout will look like, what the time frame looks like, and what that does to their investment cycle with regard to the uptake of the new iPhones that have come out. Do people really uptake based upon Apple Intelligence at this point right now? We think that might be a little further delayed than people expect. And so we're a little bit more underweight Apple and we're a little bit more overweight Microsoft. Just for that reason alone, the companies are valued actually at a very close percentage, but Microsoft is expected to outgrow over the next few years, and we think that's actually accurate.
You mentioned some of those valuation levels, and in your notes to us, you said that valuations remain expensive, but valuation as a timing tool is a difficult proposition. Can you explain what you mean by that and how investors should assess valuation when determining whether or not to buy into a certain stock or even a certain index?
Yeah, it's an excellent question because in the short term, valuation doesn't tell you much about market trends. It really doesn't. Expensive can always get more expensive and cheap can always get cheaper. But from a long-term tool, that's what you want to use valuation as. And it's not draconian. It's not saying that a collapse is coming or a crash is coming. But when you're expensive like we are right now, really what you should expect is sub-average returns, right? If you're 8 to 10% over a long-term average, when you're paying more for the market, you should probably expect a little bit less than that. And in the same way goes the other way. When the markets are cheap, you should probably expect a little bit more over the long term. But if you're looking at valuation and saying, well, valuations are expensive, there's a 20% correction coming, That's just a really difficult proposition because markets in the short term tend to be trend following for the most, and you need something to disrupt that trend. And valuation just really isn't a good timing tool for that purpose.
You said there aren't a lot of catalysts that could derail this market through the end of the year, but a potential catalyst could be what happens at that November Fed meeting. Markets are pricing in a near-term rate cut of 25 basis points. But based on recent economic data, some commentary from Fed officials, do you expect the Fed to be less aggressive with its pace of cuts? And if so, what could that mean for equities and the economy at large?
Yeah, certainly less aggressive than the 50 we saw to start, right? I thought you were going to mention another November event that could absolutely have an impact on what's going on in the markets. But, from both of those perspectives, if you will, I think the Fed has some capability to saying, hey, 25 basis points, you're still probably there, right? Is that there's nothing that's telling us in the data right now, and the Fed has said many times that they're data dependent, that would suggest economic deterioration that requires them to be as aggressive as they were at the outset. But they also have inflation that's coming down relatively to normalized levels. The job growth is still there. So I think there's still an avenue for them to drop by 25 basis points at this next meeting, but also give the commentary that they're not committed either way in the future, right? Is that, hey, we're still seeing the trends that would allow us to get to our targeted level. We're going to get there on a prudent basis. I think that's the commentary you'll see. But I still think 25 basis points is probably still the most likely scenario for the Fed.
Jeremy Bryan, Gradient Investment Senior Portfolio Manager, thank you so much for your time this morning.
Thank you.
Millions of Americans could receive relief from financial hardships. The Biden administration unveiling a new proposal today that would offer student loan forgiveness for those who experience economic hardship from things like natural disasters, high child care costs, or unexpected medical bills that prevents them from paying off their loans. If the proposed rules are finalized, approximately 8 million borrowers could be eligible for forgiveness. The Department of Education could use several factors to determine if someone is likely to default on their payments, including household income, age, whether they receive public benefits, and their overall debt. Next up for the proposal, it enters a 30-day public comment period. You can actually submit your thoughts through the website regulations.gov. The Department of Education expects to finalize the proposal in 2025. Coming up, we break down how to navigate this year's tight holiday job market. That's right after the break. As competition heats up for fast food and fast casual chains, a loyal workforce is crucial to keeping customers happy. But it seems like many restaurants are struggling to retain their employees. Here to break it down is Brooke De Palma. And Brooke, this has been an issue that's really been happening since the pandemic, right?
Yeah.
What's the issue here, and why are these restaurants having problems keeping their workforce?
At the crux of it, a higher turnover rate really does lead to a poor sales performance in terms of sales growth and overall throughput, the amount of time it takes customers to get through. And the odds really are against the leisure and hospitality industry. We know that the quit rate in the leisure hospitality sector outpaces the national quit rate. That runs at about 3.3% compared to a national average of 1.9%. And this really is because these jobs are typically lower pay. There's more varying hours. But it's important to note here that we have come back post-pandemic. Staffing levels of fast food and fast casual, they're up 4% compared to pre-pandemic. So that's good news there. But there's still a large amount of jobs that are unfilled. We now know that in the leisure and hospitality sector at large, about 75% of jobs are filled, 25% of jobs are unfilled. And that's really why you've been hearing so many fast casual and fast food chains really double down on benefits, double down on wages, and also even some like Chipotle offer stock splits as well.
Yeah, and what do workers really want here? Is there a desire to have more flexibility in schedules, more flexibility in some of the plans that they're offered as well?
Yeah, I think there's more flexibility wanted, a higher wage, a higher pay package, and really room to grow here. They want to have a career roadmap ahead of them and understand how they can get ahead and really grow within this role, as opposed to just saying it's a one-off and there's no room to grow.
How about automation? Because we know Sweetgreen, we know Chipotle, they've experienced with their own automation. Is that helping things, or is that kind of taking jobs away from folks that want them?
Yeah, for some, it spooks. It's saying, hey, am I going to lose my job because of this new innovation? But the company is really touting that this is actually helping less stress on their employees. Take, for example, Sweetgreen's Infinite Kitchen. That's a robotic assembly line. Well, Sweetgreen really touting that they're able to get an increase of orders. They're seeing improvement in turnover, retention, and sentiment. And they also see the average ticket boost. So customers are spending more when they're not ordering with someone. Keep a lookout. Brian Sazzi spoke to the co-founder of Sweetgreen, Nicholas Jamin. That's going to be more an opening bid next week. But we're also hearing a company like Chipotle. They've been testing out these robots like Autocado that cuts avocados. They also have a digital make line, and they made with a company named Hyphen. And really what they're getting at here is they want to see a faster serving time. They want to take stress off their employees, and they really want customers to order more. We know that customers tend to order more when they're interacting with these digital assets like a digital sign or a kiosk rather. And so perhaps it's boosting sales for these companies and also perhaps taking less stress off employees, but in no means are these replacing employees in large.
Well, that's good to know. And I would love to have that avocado robot in my house. The amount of avocados I eat.
It produces way too many though for the average person.
Okay,
so.
okay, that's true. I probably don't eat that many avocados. But we'll see. We'll see where these hiring trends land. Brooke De Palma, thank you so much for your reporting. Appreciate it. Well, 'tis the season to talk holiday shopping. U.S. retailers are already readying their plans for the upcoming season, but they are expected to hire less seasonal workers this year compared to last. Here to discuss this year's holiday job market, we have Nathan Mondragon, HireVue Chief Innovation Officer. So Nathan, less seasonal hiring than in previous years. Why is that the case? Because it feels like things have only gotten crazier during the holidays.
Yeah, the retailers hire based on anticipated sales growth, right, for the year. So for this year, they're anticipating a 2.5% to 3.5% sales growth compared to last year. Last year they had a 3.8% growth. So that projection then leads to needing less retail workers to fill the needs. But what is happening is, so there's less roles compared to last year. There's still 520,000 anticipated roles being filled as we speak. But there's also more people navigating the employment space for these part-time jobs compared to last year as well. So fewer roles, more applicants is making the competition a little bit higher compared to last year.
Right, to that point, more competitive. You're projecting a 19% increase in job seeker interest from 2022. What's the catalyst for this uptick? Are folks seeking more income as prices remain elevated? Is it more secondary jobs? What trends have you noticed among those workers who are really looking for seasonal jobs?
Yeah, the majority, over 50% of the applicants are new time workers, right? So first time to the employment space, meaning those high school, college, early adult kind of applicants. They're first time to the workforce. So there's an increase in interest in those individuals as they enter the latter stages of high school, early stages of college, early stages of the work career, and they're looking for more stability. There's also a increase in the older worker segment coming back to these part-time roles, and that is more for the secondary income, fill in the cash reserves that they might have lost through some of the market or whatever it might have been. But so there's the older workers coming back, trying to fill in secondary income, and then there's the first-time workers coming in trying to get their start and looking for the experience essentially.
And if you're one of those job seekers, is now the time to start looking? It feels early, but then again, we have the pumpkin spice lattes come in the summer. So I feel like corporate America is always chugging ahead. But when should you really look for these types of roles?
Yeah, holiday hiring really starts in September. The retailers, the large employment groups, the retailers, the warehouse districts, the food and beverage, the hospitality, et cetera, they start staffing up in planning for it in the summer and then start in September. So now is absolutely the time to begin that looking for those jobs and doing the applications and getting in the process.
And how have we seen artificial intelligence play a role in the hiring process? And have you seen the AI boom take any of these types of roles away at all?
You see, we see AI in two areas. There's certainly the area of the hiring process, which is what we build, right? We build AI-enabled hiring processes. The actual jobs themselves being staffed, yes, there are some changes. And on your earlier segment, you were talking about some of what's happening is the automation is coming in the ordering process for food and retail, in the ordering process and in the food making process, which means they're taking the employees and ramping them up on the customer service and friendliness side. So they're wanting people, instead of waiting in line to order their food, they're going through the kiosk, and then the job might be made by a robotic process, but the employees are being hired into a more increased service orientation type role of dealing with customers.
Got it. Nathan, finally, what types of roles are seeing the highest demand right now?
What we're seeing this year is there's as in last year, a real increase on the e-commerce side. So almost an 8 to 9% growth compared to the 3.5% growth in retail. We're seeing the 8 to 9% growth in the fulfillment centers, the drivers, warehouse workers, et cetera. So that's where a big increase is, and that is a different profile of an employee because they're not customer service oriented. They're more dependable. They're looking for dependability and safety orientation, as an example, in some of the key competencies. And then there is an increase in the hospitality and event staff as well, where they're ramping up the festive occasion, right, of the holidays and trying to get more event type activities into some of these hospitality areas.
Nathan Mondragon, HireVue Chief Innovation Officer. Can't believe we're already talking holiday shopping, but appreciate your insights.
Yeah, you bet. Thank you.
Coming up, what's the best financial advice you've ever received? We'll dig into some advice that Jeff Bezos once gave. That's next on Wealth.
He goes, every day is day one. I wake up every day as if I have nothing. As if I've done nothing. What can I do today that will be impactful?
That's the advice billionaire Jeff Bezos gave to CNN political correspondent Van Jones. He joined the Financial Freestyle podcast with Ross Mack this week. And Ross is here with me now in studio. And Ross, if you're going to get financial advice from someone, Jeff Bezos, probably a good one. What did you think of that advice, that it all starts day one?
I love the conversation, right? I think that Jeff Bezos is speaking from a different standpoint of privilege in the sense of like, day one for him, he's still a billionaire. So I always had to say, like, do I want to think that way? And I think that one, you have a clean slate, you have the ability to do good in society, but I don't want a person that's trying to get on the wealth path, right, to actually try to get on a pathway of becoming financially free to think every day is a new day, because that's an issue in the sense of like, oh, I got to try to get rich in one day. And that's the one thing I think people need to understand, that every day is an ability to compound on the previous days. And so when you think about, trying to actually become wealthy, it's power in compounding. It's power in staying disciplined and consistent. And over time, that's truly how you can gain wealth. It's over time, truly how you can finally get out of debt and finally start building towards becoming financially free, having that full retirement plan, finally paying off that student loan. And so for me, the idea was like, I get it, but to the average American, I think, the average person shouldn't go into it saying, I want to get rich in one day. I think they need to say every day, I want to get closer to my end goal, which is I'm trying to retire by 60, I'm trying to retire by 50 or 70, whatever that age is. There's a way to truly work backwards and understand there's power every day, because just 1% getting better every day, as opposed to just starting off zero. Like, if you aim to get better 1% every day, then you have the ability to actually reach that goal.
It's an opportunity every day, right?
Absolutely.
So what's the best financial advice you've ever received? I was trying to think of mine, too.
Yeah, well, I think mine is, one, pay yourself first. Right, I think in society we're conditioned to paying bills all the time, right? Like, no matter what, first of the month, you're paying whatever bill it is, light bill, this, that, and the third, rent, mortgage, et cetera. But another thing is, we're not told to pay our future selves. And I think the idea, and when you say like the average person is, living paycheck to paycheck, the average person isn't prepared for retirement. Well, the idea is starting to be disciplined and paying your future self starting today. That's a great form of advice. And then another one is just dollar cost averaging. I think, going to that point of saying, do we start every day like it's day one, or do you have the ability to build on the previous days? And I think that's what's important about dollar cost averaging, where you're not guessing if the market is going to go up or down, irrespective of what your views are. You're buying certain investments every month or every week or whatever it is, and that's something that I live by.
Yeah, that's great advice. I think mine would be not living above your means, which, can be a tough one sometimes, especially the holidays coming up. We just had a holiday shopping.
I mean, we got shopping, we got Black Friday.
Yeah,
you kind of got to ball out, right?
So you have to make sure you have a budget. You make sure you go into it with a clear head. But that's some great advice there. Thank you so much, Ross. And you can watch his podcast on Yahoo Finance's Financial Freestyle every Monday at 12 p.m. Eastern on all of your favorite podcast platforms. Alphabet leads next week's Magnificent Seven tech earnings just before we hear from Microsoft, Meta, Apple, and Amazon. But Alphabet trades under more than one ticker, so how do you know which stock makes sense for you? Joining me now to break it down is our very own Rochelle Akufo. So Rochelle, give us a lowdown on Goog versus Google.
That's right, Ali. So Google's parent company, Alphabet Inc., they offer actually 3 classes of shares, each with different levels of voting power and ownership structure. So here's a quick breakdown. First, you have Class A shares. They have the ticker Google, G-O-O-G-L. Now, that gives you voting power of 1 vote per share. Now, in terms of purpose, investors can participate in shareholder meetings and vote on corporate matters, for example, electing board members. In terms of your typical investor profile, usually it's institutional and individual investors who want a say in the company's governance. Next, let's look at Class C shares. Now, those are the ones that have the ticker GOOG, that's Goog. Now, these don't come with any voting power, so why buy them? Well, this actually came into effect as part of the 2014 stock split, issuing non-voting shares to the public so that they could raise capital. Now, that doubled Alphabet shares without diluting that insider control away from founders Larry Page and Sergey Brin and other executives. So investor profile. This is for people who are just more focused on the potential returns through that stock price appreciation, more so than voting on corporate matters. Now, if you're wondering if we skipped a letter, yes, there are Class B shares, but they are not publicly traded. Now, for those, the voting power is 10 votes per share, and these are actually held by founders Larry Page, Sergey Brin, and some key insiders, and this was when the company first went public. But for the shares that you can invest in, you'll notice that Goog and Google usually trade at very similar prices, but Class A shares usually trade a little bit higher thanks to that premium that comes with those voting rights, Ali.
Rochelle Kufo, thank you so much for that breakdown. And you can watch Rochelle on Yahoo Finance's Capital Gains podcast every Friday at 12 p.m. Eastern on your favorite podcast platform. On today's episode, Rochelle, Rick, and Ben are talking about Elon Musk and other billionaires weighing in on the election. You don't want to miss it. It's now time for our wealth tip of the day, and today we're taking a look at improving your tax picture with a deadline to make moves to reduce your 2024 taxes just around the corner. First up, be sure to evaluate your paycheck withholding or quarterly payments. To avoid underpayment penalties, filers must pay at least 90% of the tax shown on the return for the taxable year. Another way to avoid these penalties for 2024 is to pay an amount equal to either 100% or 110% of your 2023 taxes, depending on your adjusted gross income. For filers paying quarterly estimated taxes, January 15th, 2025 is the payment due date for the September 1st to December 31st payment period. As for reducing your taxable income, filers can either go with the standard deduction, which is a fixed amount. For 2024, the standard deduction is $29,200 for married joint filers and $14,600 for singles. Or taxpayers can choose to itemize their deductions using Schedule A to determine and calculate items qualifying for deductions. Lastly, consider taking a look at tax credits. While deductions lower taxable income, a tax credit typically is a dollar-for-dollar reduction of the income tax owed. One type of credit to look at is the home energy tax credits. In 2023, 3.4 million filers claimed more than $8 billion in credits tied to improving the energy efficiency of their homes. Now, these credits fall into two categories: the Energy Efficient Home Improvement Credit and the Residential Clean Energy Credit. Both of these saw credit amounts and types of qualifying expenses expanded by the Inflation Reduction Act of 2022. So make sure to keep those in mind when you file. Much more on wealth after the break. Keep it right here on Yahoo Finance.
The election is just around the corner, and many people are wondering what to do with their money now and after the election. Hi, I'm Bob Powell. Welcome to Decoding Retirement, where we hope to go behind the headlines and help you plan for retirement a little bit better today than you did the day before. This week, we're going behind the headlines with Larry Sprung. He's the founder of Midland Financial. Larry, welcome.
Thanks, Bob. Thanks for having me.
It's a pleasure to have you here. It'll be a pleasure to go behind some of the headlines, specifically some of the economic headlines. I know you're a fan of Brian Westbury from First Trust, as am I. And he, as you know, writes lots of reports about economic headlines. And I want to just jump into some of the things that he wrote about recently and get your reaction. One of them has to do with inflation and retirement. And right now, the current trend in core inflation is that it's stalled at about 2.6%. And what impact is that having on the purchasing power of retirees as well as those saving for retirement? Any impact from your point of view?
Yeah, so the good news is we're at 2.6%, and the bad news is we're at 2.6% because looking backwards, we're far lower than where we were 6-12 months ago. So that's a huge benefit. But at the same time, inflation has a huge impact on people's purchasing power, and we've definitely seen them impacted over the last several months, if not a couple of years, and people have to plan for if things don't go as planned, that inflation, even at 2.6, may be here for a little longer than they expect.
Yeah. I sometimes think about inflation as a double-edged sword, right? When inflation was low, when we lived in the zero interest rate policy environment, people would say, I'm earning nothing on my money. But on the other hand, they weren't suffering from a loss of purchasing power either at that time. Then we saw interest rates go to 9%. They earned a lot more money, more on their money. They also spent a lot more on groceries, et cetera, et cetera.
I agree with you 100%. And the people that were most impacted over that 20-year period where interest rates were virtually zero and there was no return on, savings accounts and bank accounts were typically retirees, and they were used to much higher returns on those monies, previous to that huge decline in interest rates.
Yeah. So if you're a retiree and maybe you're on limited fixed income, Social Security, maybe a pension, you're withdrawing money from your IRA, what might you suggest in terms of investment strategy? Tips, inflation-protected CDs, or what? What's the option?
Everybody's situation is personal, right? And everybody has a different risk profile in terms of what their ability to take on different risk assets. So there's not really this unisex, Swiss Army knife that you can say this will work for everyone. I really think it's important that everybody have a plan, whether you're retired or a retiree or moving towards retirement. It's important to understand what those goals and objectives are, what your time horizon is, and what investment vehicles are going to work best for you. Now, we had people looking at that not too long ago as interest rates were rising to put that plan together. Now it's going to be important as we start entering potentially a lower interest rate environment to start putting that game plan and being prepared for that lower rate environment, because those who've gotten used to these higher rates on whatever vehicles, whether it be CDs and tips and things of that nature, they have to start looking and seeing what's going to work best for them from this point forward.
Yeah. And I like to tell people, and be curious for your reaction, that in terms of what they earn on their investments, they should always be looking perhaps to earn a little bit more than the rate of inflation, than CPI, plus whatever taxes, right? What their after-tax rate is minus CPI?
100%. I mean, it's not really what the return is. It's really what do I get to keep when all's said and done. And if your return is, 5%, you then have to take off inflation. You then have to take off what you owe in terms of taxes and see what you're really left with when all's said and done. And if that's a number that you can live with, then that might be an investment that works for you. If it's not, you might have to look elsewhere.
Yeah, so one of the things that we like to do on the show, Larry, is to decode things. And so I think what you've just mentioned is the difference between a real rate of return and a nominal rate of return.
Correct. And they're very, very different.
Yeah, I remember people used to say, oh, I used to earn 19% of my CDs back in the Jimmy Carter years. And I'd say, well, yeah, but inflation was 21%, so you were actually a negative 3 real return.
Yeah, and I'll share something, that's happened with families that we worked with. They look at some investments out there, and I'm not picking on REITs. They're right, and they're good investments for the right people. But we've had people say to us, hey, I see this REIT and it's paying 8, 9, 10%. And, why are we not allocating funds there? Now, when you look at that 10% yield, it looks great. But then when you look at the total return of the investment, if it's gone negative, that 10% may not be what your real return is. And then you factor in those other things, inflation and taxes, and, you have to evaluate it with all things being considered.
Yeah, so I'm going to decode REIT for a second, which is real estate investment trust. Yes. Which are in some cases publicly traded,
yes.
And in some cases perhaps not.
Right.
Yeah.
Right.
All right. So Brian Westbury also mentioned that personal income and spending is up 4.5% in the past year. What are the implications of that?
I think personal income is a great determinant about how the economy is going. As personal incomes rise, it's a good indication of where the economy stands. And I think personal income, as long as income continues to rise, that'll keep things strong, because then that will help support consumer spending. And I know, we might also even talk about credit, for example. There's a lot of talk about credit card debt, for example, being at all-time highs. But when you look at it, also personal incomes are also at all-time highs. So maybe it's not as bad a situation as some may paint that to be.
Yeah, we've seen wage growth rise. We've also seen consumer confidence rise, which is certainly good for, I think, the economy in general, if perhaps GDP is what, 2/3 consumer spending?
Yeah, virtually. That's the main driver of GDP is consumer spending, for sure.
Yeah. So Brian Westbury also mentioned that consumer spending and fiscal policy issues. He said with government pay and transfer payments rising significantly, how might future fiscal policy adjustments, such as maybe reduced government spending or higher taxes, affect retirees and those saving for retirement?
Yeah, I mean, listen, we're going to have a big shift coming in the next administration, right? We have the Tax Cuts and Jobs Act, which is going to set to sunset at the end of 2025. So we're going to either have to see things go back to the way they were, I believe, in 2017, or some new legislation. So there's certainly some things that we have to be aware of. And retirees, obviously, those especially on some kind of fixed income stream, Social Security makes up the largest portion of most retirees' income stream. If you start looking at taxes on top of that and their ancillary other areas of income, that certainly can have an impact on what they end up taking home each month.
Yeah, I'm curious, if you're a betting man, how do you expect the Tax Cuts and Jobs Act to expire, sunset?
I wish I was a betting man, but I'm not. And I don't think it's going to sunset. I think there'll be some kind of meeting of the minds. I just don't know where that will be. I would like to think that it's not going to stay the way it is today. But at the same time, I don't foresee it going back to where it was back then, even adjusted for inflation. I think it's going to be somewhere in between. But that'll also depend on what happens with regards to the election, which party gets in as in terms of the presidency, and which party is in control of Congress. I think those two things will have a big part in what happens next.
So is there any way to plan for that now?
I don't think so, and I don't know that you have to necessarily, because we have the election only a few months away here, and we'll have an idea of where we stand in terms of what party is going to be in charge of each of those branches of government, and they don't expire till the end of 2025. So my expectation is 2025 is going to be an extensive planning year for many people on many different fronts, because of this.
Yeah. So when I talk to my CPA friends, sometimes they say, when we think about the future, that if the one party doesn't control the executive branch and both houses, things are unlikely to change, and either way, right?
I agree with that wholeheartedly, and the markets will show that the markets in general tend to perform better when there is that division of power as well.
Yeah. I should have probably mentioned this earlier when we were talking about personal income rising, but Brian Westbury also mentions that the savings rate has dropped to around 3%, significantly lower than the pre-COVID levels. Does that have any impact on the world?
I mean, we want people saving. I mean, clearly now, especially those that are entering the workforce now, maybe not necessarily retirees, their retirement is their responsibility. It's not like it was 50 years ago where you worked for a company and had that pension. So looking at that savings rate, it's important. But I would also say that I think COVID threw a real wrinkle into things. And what I mean by that is over the COVID years, right, people weren't spending during that period of time. And when people got out of COVID, there was almost like this sigh of relief that, oh, you know what, I have to do things and make purchases that I wasn't able to do. So I'm wondering if that ends up reverting back to higher levels like we were pre-COVID in the years to come as we get further away from that COVID pandemic era, if you will.
Right. And as we're taping this show, there's a little bit of worry about an economic downturn. If people aren't saving enough to weather any economic downturn or longer recession than expected or anticipated, they could be putting themselves in harm's way.
Yeah, we're a big fan of having an emergency fund. It's just as important to have that emergency fund as it is to save for your retirement, because most people, if you think about it, are really one major or even a minor event away from not being able to pay for that specific emergency event. So it's important to have that emergency fund and be prepared for a downturn or anything else that might be a large impact to your income stream.
Yeah, so most people suggest 3 to 6 months, but it could depend on circumstances, perhaps.
Yeah, I mean, I think that, depending on your work circumstances, if you're a W-2 employee, that you're in a field that you're, very, somebody who's in demand and can find a new job very quickly, 3 to 6 months is very advisable. Those who may be self-employed, where they'll be in a situation where if there's an economic downturn and it could significantly impact their income and their household, we like to go to, 6 to 12, and some cases even 18 months to make sure that they're insulated.
Yeah, and for retirees, I think, okay, well, you're not in the workforce. It's not like you're going to lose your job. But there are things like new cars and new roofs and new appliances and maybe a grandchild that needs to have a college education paid for or a wedding paid for or something like that.
There's always something. If you want to spend money, there's a way to do that, right? And it's a matter of, even if you're a retiree or entering retirement, it's a matter of being, intentional about it, having a plan. Talk to your advisor if you have one and let them know that my intention is to help my grandkids pay for school or my grandkids for their wedding or whatever the case may be. Have a plan for it so you're prepared for that spend when it takes place.
Right, and it could be that you might need to set aside, 1 or even 2 years maybe of spending to accommodate these unexpected expenses.
Yeah, I mean, well, hopefully these are not unexpected. Hopefully you're planning for these expenses like a wedding or something of that nature. Really, the emergency fund should be for, loss of a job, roof repair, things of that nature that come out in an emergency situation.
All right, one last question about the housing market. Brian Westbury mentions that home sales are falling, existing home sales are expected to decline. And I think about older Americans who want to age in place, but also we're thinking about how do I use the equity in my home to cover living expenses? Should I downsize? Should I relocate, et cetera, et cetera? Any thoughts about?
It's a challenge. I mean, in certain areas, there is no such thing as downsizing. Where I'm from on Long Island, it's very difficult to go from where you are, where you may not have a mortgage and you're just paying taxes and insurance, to actually downsize and see a significant savings. So it's difficult unless you're going to find a location that you're going to move out of the area where there is going to be a significant reduction in cost. It takes homework. You have to look at that. And I would say, in my view, the housing market has been on a heck of a ride in the last, couple of years. And there's going to be a reversion to the mean at some point, I would imagine, just like anything else.
Yeah. Larry, we have to take a short break, but first I'm going to answer a reader's question, and when we come back, we'll talk more with you about small business owners and also social media influencers who like to talk about money. So a reader asks, I'm looking to buy a long-term care insurance policy. One policy has a reimbursement option and the other an indemnity option. What's the difference between the two? Well, here's the answer. The reimbursement option pays back the policyholder for approved long-term care expenses they have paid during the month, while the indemnity option, the insurance company sends the policyholder a fixed monthly payment no matter how much the care actually costs. So I talked to Scott Olson from the LTC shop about this question, and what he had to say was this, that reimbursement policies are usually less expensive than indemnity policies, and that the only time an indemnity policy is better is if someone wants to use a non-qualified caregiver to provide their care, like a family member or an unlicensed home health aide. Otherwise, most of his clients buy the reimbursement policy. Welcome back to Decoding Retirement. Today I'm talking with Larry Sprung from Midland Financial. Larry, one of the things that you're fond of talking about is small business owners and how they can plan for improved financial security. What's on your list of things that they need to consider?
Yeah, I think small business owners are concentrated very heavily, rightfully so, on their business. It's typically one of their largest assets, and they should be focused there. But there are other things that business owners really should be thinking about in terms of their own retirement, setting up potentially a retirement plan. Whether it's a real small business and it's just them, it might be helpful to their bottom line and tax savings. If they have employees, their employees might be clamoring for the ability to save for retirement. So I think sometimes business owners are super hyper focused, which is great for them and their business, but at the same time, trying to think outside of the box of just what needs to be done for the day-to-day of the business is helpful and could help their retirement as well as the financial future of their employees as well.
Yeah, sometimes these small business owners are chief cook and bottle washer, right? They have to be their own employee benefit and HR department, et cetera. When you think about retirement plans, 401ks, SEP IRAs, et cetera, what?
Yeah, I mean, they've become, it's become much easier to enter the 401k arena. So it really depends on the makeup and the scope of the business itself. What's their employee pool? Are they mainly part-time, full-time? There's a lot of mandates that are coming into place where, depending upon the size of your business and the workforce, chances are you're probably going to have some kind of retirement plan in place in the coming years for your employees. So it's important to get ahead of that and have a conversation with a trusted advisor so you know what you're going to potentially have to do so you can plan for it accordingly in a way that will help you, your employees, and your business.
Right, and there are so many options that people have available to them, right? They could put in place a cash balance plan, for instance, or a defined benefit plan, or other things that maybe help them realize what they're trying to do, which is improve their retirement security, but also maybe retain employees.
Yeah, I'll share a quick story. We had a family that it was a family-owned business, two sisters that were owners. A couple of years ago, they had $1 million in profit, and we were able to set them up with a cash balance plan, basically defer roughly $350,000 into that plan, and we saved them almost $180,000 in tax as a result of setting up that plan. And it's been something that's been in place ever since and continues to give them tremendous tax savings.
Yeah. So what about in terms of a lot of times small business owners, they don't think about it, but they need to think about succession planning.
Succession planning is very, very important. And I think, again, going back to their hyper focus on their business, really the whole idea of the business, even though, most business owners don't want to hear it, when they set out and everything they do within their business should be with the intention of some type of succession down the road, whether it be them selling the business, whether that be a family member taking over the business. But if you wake up each day and run the business with that type of mentality, it's a lot different than running the business in terms of my personal piggy bank or my personal income. And it expands the ability for the business to do even better things. And in the case of a life event where maybe there's a health event or something like that, at least you've been planning for this event for a long time at that point.
Right. And is that even the case for someone who describes their business as a lifestyle business?
Somebody who describes their business as a lifestyle business, if they're going to think that way, then they have to feel comfortable with what the consequences may be if they haven't planned for that succession. And if that's something they're comfortable with, then that might work for them. I don't know that that would work for me.
Yeah. Okay. Let's turn our attention to the world of social media. There are many, I guess they're described as what, finfluencers? Is that the term of art?
Yeah.
Yeah. So there's a lot of them out there
Yes.
on TikTok and Instagram and other places that are sort of espousing something or other about money. How do you help people evaluate who to trust and who not to trust in that world?
Yeah, it's a very difficult thing, and I think when you're scrolling and looking at some of these folks that are giving the advice, you have to be very careful about who you're taking the advice from. We've seen in recent years people giving out and espousing this advice, as you say, and people following it, and 2 weeks later their TikTok handle is gone, evaporated, because the information they gave was wrong or hurtful to those followers. So you have to be careful and look for those individuals or those companies that have credentials. They have, a following behind them, not just a social media following, a following of success in this profession. We get calls all the time. Hey, I saw this on TikTok. Should I do it? And you know what? There are certain things on there that, generally speaking, they're not bad. They're just not right for everyone. And then there are other things that say, we've seen headlines like, you shouldn't put money in a 401k, put it into a whole life insurance policy. I don't think that works for most people, and you have to be careful.
Yeah. So I know, for instance, in my case, I'll use my daughter as an example. Despite all the times that we've ever talked about money, it wasn't until she listened to Mrs. Dow Jones on TikTok that it finally resonated. Now, I think there's, in this case, there's someone that you can trust, perhaps, or at least someone who can get you into the world of talking about money.
Yeah.
Is that helpful in and of itself?
Yeah, I mean, I think it's a way, I have no issue with these platforms. I think they're great platforms, and there are certainly great people that are stirring up conversation, and like with your daughter, getting them to think about things that they not necessarily had thought about before, and that's great. I think where they fail is some of these execution where they say you should be doing this or you should be doing that. I think that's where you really have to understand who you're taking that advice from, who is it really benefiting, and are there other people with greater credentials that you could run it by to see if that makes sense for you before you actually pull the trigger and go ahead and do it.
Yeah, so a similar topic is related to AI, and I've been recently asking AI, Perplexity, ChatGPT, Gemini, personal finance questions, and then asking a subject matter expert to critique those answers, and invariably it gets some stuff right, some stuff wrong, and then there's some serious material omissions. I would never trust AI at the moment with any personal finance question.
Not now. I mean, I've done the same. I've run questions by them to get topics for blog articles and things like that, and I've noticed really a lot, several inaccuracies there. So I think you have to be very careful there as well, and use it as maybe an idea generator, but have a expert or somebody that is a professional double check to make sure that what the AI is telling you can be done, or the way to do it is actually something that would work for you or smart for you to do.
Yeah, and I can tell you from my experience anyway, using Perplexity, there are many others. At least in Perplexity's case, they are sourcing where the information is coming from, so at least I can double check the source, if nothing else. In ChatGPT's case, it's no source.
Yeah,
so
you don't have that benefit with ChatGPT, getting that source. But if you're going to run, I guess, those questions, Perplexity is probably a better option for those types of questions.
All right. So one last question. You're a hockey fan. You're a Rangers fan. I'm a hockey fan. I'm a Bruins fan. You still play hockey. I still play hockey. We're going to have to maybe go on the ice someday and maybe skate together.
Sure. I'm open to it. I love getting out on the ice. We were chatting earlier. Had the opportunity to skate with both my boys this weekend in a 24-hour charity game. I'm a little sore today, but it's a sport that I thoroughly enjoy, and it sounds like you do as well.
Yeah, it's a good sore feeling to have, I think. So, Larry, I want to thank you for sharing your knowledge and wisdom with us today and our viewers. It's so greatly appreciated.
Thanks for having me.
Pleasure. So up next, we're going to answer some questions from our readers in our segment that we call Ask Bob. Up now is Ask Bob, where we answer reader questions. A reader recently asked this, if they need to file the Form 706 estate tax return. And the answer is this: you need to file an estate tax return if the total value of everything the deceased person owned, plus their taxable gifts and any gift tax exemptions they used, is higher than the filing amount or filing limit for the year they passed away. The filing limit for 2024 is $13,610,000, and only 4,000 people had to file that form in 2023. And of the 3 million people who died in 2023, that means the odds of you having to file such a return is 750 to 1. Thanks ever so much for watching Decoding Retirement. If you have a question about money, about retirement, email me at askbob@yahoofinance.com. Stay tuned for more Decoding Retirement in the weeks to come. And also, keep watching Yahoo Finance for more retirement news.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
That's it for Wealth. I'm Alexandra Canal. Stay tuned for Market Domination. That's coming up at 3 p.m. Eastern.